Good morning and welcome to the 50th Annual Estate Planning Seminar. I am Michael Walker, one of the partners at the Portland law firm of Samuels, Yolen, Cantor, LLP. This year, it is my honor to be co-chair along with Joylyn Ankeny of our 50th Annual Seminar. When we started planning the seminar last year, as the COVID-19 pandemic was just beginning, it soon became clear that the 2021 seminar would look very different. However, through some great technology, we'll all be able not only to attend the seminar and watch our great speakers, we'll also be able to interact with our sponsors as well as each other. So I hope you've got your morning coffee and beverage and are making yourselves comfortable at home or your office. We have a wonderful lineup of speakers today, our first of two half days. I've read through the materials and there's so much insightful, practical estate planning information to incorporate into your practice. Throughout the 2 days of the seminar, you will hear about the latest developments in estate planning from an outstanding group of national experts. I do want to give you a quick overview of the virtual event site before we start. Hopefully, when you received your login on Monday, you had a chance to peek around the site. Or if this is your first time, that's fine. This is a simple interface meant to mirror the way you would move around an in-person event. If you take a look at the top navigation, you'll see the lobby, exhibit hall, auditorium, and lounge. These are the main areas of our event, and the lobby is where you started out today. Click each link and you'll be taken to that space. The exhibit hall is where you'll find our sponsor booths, which are full of helpful information and resources. The auditorium is where you are now, where you'll see a list of our speakers and times for each day. And you can click join in order to watch that live stream. Finally, the lounge holds 3 more areas for additional networking and discussion topics. If you need assistance, just head back to the lobby and visit the help desk, where live technical support chat is available to you. You can also click at the right top in any screen where there'll be tech support email if you'd rather do it that way. I'd like to say a few words now about membership in the Estate Planning Council. If you are not a member of the Portland Estate Planning Council, we hope you will consider becoming one. We also would like you to know about our membership category called Pathway Membership. This membership is designed to encourage young professionals to become active in the Estate Planning Council. It is available to those now working in the estate planning field who do not yet have the required 5 years of experience to become a full member, but who have at least 2 years of experience in the appropriate professional designation. If you'd like to apply or learn more, we have Estate Planning Council members available in the networking lounge to answer your questions. So let's briefly go over our schedule. Our session today will begin at 8:15 and continue until 10:30 a.m., where we'll have a break. We will resume our session at 10:45 and go through noon. After our third speaker, Sam Donaldson, we have an extended break from 12 to 1:15 in the exhibit hall. We will reconvene tomorrow morning at 8 a.m. with a similar schedule. My colleague and co-chair, Joylyn Ankeny, will provide tomorrow's opening remarks. I encourage you to log in a few minutes early to take advantage of early networking. So now just a few housekeeping points. For continuing education, credits are available from many designations. Please review the certificate of attendance sheet that is inside your packet download. That sheet outlines how many credits are offered and details needed to obtain the credits. Our events software will keep track of what you logged in and logged out. You will not need to sign in or sign out to have your continuing education credits recorded. I also encourage you to fill out our seminar surveys. Evaluations will go live in the lobby via the survey link at approximately 5 p.m. Please help us provide the best seminar possible by completing the evaluation. Our planning team for next year will review those surveys carefully as we start the planning process for the 2022 seminar. As always, all collected evaluations will be entered into a drawing for a complimentary registration to next year's seminar. We also have some areas for competition where we'll have a leaderboard that you'll see in your top navigation. Our virtual event will be awarding points to attendees who are active and take part in different areas of the event. I also want to thank our sponsors for their generous support. We have 4 networking periods in our 2-day event during the mid-morning break, as well as immediately after the last speaker on each day. So take some time to say hello, as without those dedicated sponsors, our seminar would not be possible. Our sponsors have great information, products, and services to assist you in your practice. Please be sure to visit and learn about their services, as well as filling out their online forms for prizes that you can win. Sponsors will notify winners after the event. You can also click Chat Now in any booth to connect with a booth representative or an online user. It's a great way to catch up with people you may not have seen in a while. First, I'd like to recognize our gold sponsors. They are Ferguson Wellman Capital Management, MUFG Union Bank, US Bank Private Wealth Management. And next, our silver sponsors. They are Aldrich Allen Trust Company, Aldrich Messina, Bank of America Private Bank, Becker Capital Management, Bonhams, Candace Jennings Consulting, Columbia Trust Company, First Republic Bank, Guide Dogs for the Blind, Key Bank, Key Private Bank, Moss Adams, National Christian Foundation Northwest, OHSU Foundation and Gift Planning, Oregon Community Foundation, Oregon Humane Society, Oregon Jewish Community Foundation, Oregon Pacific Bank, Perkins and Company, Riverview Trust Company, Umpqua Private Bank, Washington Trust Bank, Wells Fargo Private Bank, and Whittier Trust Company. Now I'd like to introduce our first speaker, Steve Triton, who will be speaking on estate planning for retirement plans after the Secure Act. Steve Triton is a nationally recognized authority on tax, estate, and business succession planning, quoted in financial publications such as the Wall Street Journal, Forbes Magazine, Bloomberg Wealth Management, Kiplinger's Retirement Report, and the Los Angeles Business Journal. Steve lectures to tax and estate planning professionals across the country at such programs such as American College of Trust and Estate Counsel national meetings, the Heckerling Estate Planning Institute, ALI, CLE programs, the Hawaii Tax Institute, the NYU Tax Institute, and many other great national programs. Steve's recent publications include his papers for these events, as well as articles for Trust and Estates Journal of Wealth Management and other publications for professionals engaged in tax and estate planning. Steve is a fellow of the American College of Trust and Estate Counsel and serves as chair of the ACTEC Employee Benefits Committee. Steve is also a certified specialist in two areas, taxation law and estate planning and probate law, certified by the Board of Legal Specialization of the state of California. Steve teaches as an adjunct professor at the University of Miami Law Graduate Program in Estate Planning. Steve also serves on the Editorial Advisory Board Retirement Benefits section for Trust and Estates Journal of Wealth Management. Steve is an active member of the American Bar Association, the Los Angeles County Bar Association, the American Institute of Certified Public Accountants, and the California Society of Certified Public Accountants. So without further ado, welcome to the 50th Annual Estate Planning Council. Steve Triton, welcome to the Portland Estate Planning Council.
In 1970. They were even excluded from the estate at that time. We had ERISA, I think it was in 1973. They took away the estate exemption in the early 80s, 1982, I think. And then RIA came in 1984, giving spousal rights. In 1986, we got more laws on IRAs and minimum distributions. We got proposed regs in 87. We didn't get final regs till 2002. And by that time, we kind of knew what we were doing estate planning for retirement plans. We saw an excise tax come and go on whether the retirement plans were too big. But from 2002, it's been kind of clear sailing until the Secure Act. And that's what we're going to talk about today. The biggest change of the Secure Act is it has taken away stretch out for most beneficiaries after death. There are a few other minor changes in the minimum distribution area and actually a whole host of other changes in the retirement plan area that we won't even be able to talk about today. But let's go ahead and start talking about the minimum distribution rules. And first, I'm going to cover a few minor rules that came in with the Secure Act. 72 is the new 70 and a half. And what I'm referring to here is when the owner of a plan starts their minimum distributions while they are alive. Prior to the Secure Act, those distributions would start on the April 1st of the year following the year in which you hit this age target, which prior to the Secure Act was age 70 and a half. Now, for those who have not attained 70 and a half prior to 2020, it's the pushed back to the year after the year in which you would attain age 72. It's still April 1st of that following year. And that's the general rule. The later rule, if you have not retired and you're a non 5% owner, still stands with respect to qualified plans. A change on IRA contributions. There's several boxes you have to check to qualify for your annual contribution. And one of those boxes is you couldn't be older than age 70 and a half. Well, they took the one box away, but remember the others are still there. You have to have the earned income. There's a phase out if you're covered by an employer sponsored plan, et cetera. That's effective for years after 2019. Now, 72 is not the new 70 and a half when it comes to qualified charitable distributions, which is actually good news because this was the age where you could begin making those qualified charitable distributions. You can still make them at 70 and a half. There was some concern in Congress about people getting the benefit of both this continuing at 70 and a half on the qualified charitable distributions, but also continuing annual contributions under the new rule for IRAs. So there's a somewhat technical calculation that sort of cumulatively tracks those benefits. And it's something that the tax return preparer probably needs to track each year as part of the tax return process. Now we're going to enter the post-death minimum distribution rules, and this is pretty much where we're going to be the rest of our program this morning, because this is really the headline topic. Congress, in their minds, offered some very favorable rules for retirement plans in the Secure Act in other sections we're not talking about today, and they felt that they needed to pay for them to keep the bill revenue neutral. So the way they're going to pay for it is they're cutting back the stretch out on post-death minimum distributions. Those of you who draft revocable trusts, you'll know that when you're going to make a change, you have a choice. You might do a complete restatement of the trust and rewrite it so you have one comprehensive document, or you might cut and paste a few changes into an amendment, and then you have to read the prior document along with the amendment together to really know what you're doing. Well, guess which approach Congress used in the Secure Act? They did not do a comprehensive rewrite. They grafted some new rules onto the existing rules. What does that mean for us as planners? First, we have to master the existing rules, and we still need to understand all of the existing rules. Then we have to learn the Secure Act and understand those rules. And then we have to read them together. We have to think in terms of existing rules and how Secure Act is grafted on top of them. I had the privilege of being a co-chair of an ACTEC task force that submitted comments to Treasury, suggestions on points to clarify and to address in regulations. And we had a lot to talk about. It was a big project. It was more or less a full-time job for about 2.5, 3 months while we worked on this. We're very happy with how our comments turned out, although we realize Treasury has many considerations to balance, and what the end result in regulations will be remains to be seen. I think these comments are a very interesting read. They're available on the public side of the ACTEC website. The link in the slide, I appreciate, is very small. It's also in the written materials. And if you just go to actec.org and look for, submissions, it's very easy to find these on the internet. I think not only are they an interesting read, they really help illustrate so many things we don't know yet. A lot of what we're talking about today is my best guess of what the law provides, and I'll try to be clear on those points that it's a guess and not a final interpretation. But there is a lot we don't know yet, and some of it are some really important issues of how do we create trusts for people who really need trusts. So one concept from existing law that's very important, and it stays with us, is designated beneficiary. It has a special meaning under the regulations. It's a much more specific meaning than who did you write down on the form. You could designate a charity and write it on the form, and the charity could get your IRA when you die, but the charity is not a all-cap designated beneficiary within the meaning of the regulations. Under the regulations, to be a DB, you need to be an individual because the regulations are based on life expectancies. And the individual, you have to have been either designated as a beneficiary under the plan or to receive under the terms of the plan. Now, when would that happen? Let's say you never filled in your beneficiary designation. And in your particular financial institution's IRA form, if you haven't filled it in, your spouse receives it. Now, that's not the most common. The most common is the estate. But at any rate, your spouse would be a designated beneficiary because the terms of the plan covered you for even though you never filled out your form. So the new post-death rules that we're going to talk about today, they only apply to some and not all scenarios. So they apply to DBs. They do not change any rule for non-DBs. They apply to defined contribution plans and IRAs, including Roth IRAs, but they don't apply to defined benefit plans. So for non-DBs, we still have the old rules. Just to recap what those were, if you died prior to your required beginning date and you did not have a DB, the 5-year rule applied, which meant the plan had to be out by December 31 of the 5th year following the year of the death. If you died on or after required beginning date, some people think the 5-year rule applies if you don't have a DB, but actually it's a different rule. Even though you just died, the distributions come out over your table life expectancy, which is a little odd, maybe even creepy. And some commentators refer to that as the ghost life expectancy. The spousal rollover rules also did not change. So DBs, we have a new overhaul on how that works. And as a general rule, a DB has a 10-year rule instead of the life expectancy method. So the life expectancy method is what we used to call a stretch out. And if I designated my 5-year-old son prior to the Secure Act and I died prior to the Secure Act, and my 5-year-old son goes to the table or his, surviving parent or custodian, whoever it is, and the table maybe gives him 81 years. Well, then he's going to gradually take distributions over an 81-year period, and the net benefit to him, net of taxes, costs, et cetera, will be really significant. Now the general rule is a 10-year rule, but we are going to talk about some exceptions, and my 5-year-old son would have qualified for one of those exceptions. Now the 10-year rule is supposed to work just like the 5-year rule. What we don't know is it 10 years from the date of death, or can we go to the 12/31 of that 10th year as the end of the period? Hopefully regulations will give us that grace period so that it's always December 31. On both the 5-year rule and the 10-year rule, there's no requirement that you take some every year. The only requirement is that everything is out by the end of that 5 or 10-year period. Under existing law, if you died with a designated beneficiary and your ghost life expectancy was a better deal than the beneficiary's life expectancy. The ghost life expectancy actually governed. We have asked for guidance whether there will be a similar rule like that under new law if the ghost life expectancy is a better deal than the 10-year rule. We don't know whether we're allowed to use that or not. It's going to be hard for Treasury to decide on this one because now we've got an apple and an orange. The 10-year rule is all payable or distributed at the end, whereas the ghost life expectancy is year by year. So keep your eye on this. I really don't know which way Treasury is going to go on this question. Now, we have 5 exceptions to the 10-year rule. And the 5 categories of DBs who qualify are called eligible DBs or EDBs. And they will get to use the life expectancy subject to some limitations we'll get to in a moment. The 5 categories are P's spouse. What do I mean by P? I'm using P in these slides to refer to the participant, which could also be the IRA owner, whoever that living person is who has the plan and then dies. So P's spouse is one category. P's minor child is another. So if P has an adult child who dies, leaving minor grandchildren, is there a move-up rule? Can we count the grandchildren? No. It has to be P's minor child or you don't qualify. Third category, any disabled individual. Fourth category, any chronically ill individual. The last category, any individual less than 10 years younger than P. And we're pretty sure that being older than P also counts as being less than 10 years younger than P. So if P dies at 75, anybody 65 or older, I guess 66 or older, should fall in that last category. Your status as an EDB is determined at the time of death. So if I die today and my adult child becomes disabled next week, that adult child is not going to fit into any of these categories. Now, the life expectancy method for an EDB isn't forever. Well, I guess it never is forever, but under old rules, if I designated my 5-year-old, and heaven forbid, after my death, the 5-year-old dies 2 years later, there's 79 out of those 81 years still available in the table. And whoever receives the IRA after my 5-year-old actually gets the benefit of those 79 years, even though the 5-year-old died. Not anymore. If we have someone who fits into one of these exceptions, they use the life expectancy method, but only while they're alive. And at the time they die, it switches to the 10-year rule. One exception is in that second category of participants' minor child. It switches to the 10-year rule at the earlier of majority or death. What is majority? You all are wondering. We're not sure. The new code section in the Secure Act, again, they wanted to keep this amendment as short as possible. So instead of writing out all new definitions, they looked for existing definitions in the code and kind of cut and pasted them in. And for majority, they found one in the defined benefit area that up till now has been used for a totally different purpose. And under this code and regs, there is a test that allows majority to be deferred till age 26 for a child who has not completed a specified course of education. Now, we don't know what specified course of education means. And we also don't know what the default age of majority would otherwise be, whether we're referring to the state law where the child lives or something else. Another point in these regulations is if that child becomes disabled before they reach age of majority, they can be treated as if they have not reached age of majority so long as they remain disabled. So this is pretty interesting, and it could make figuring out who's a minor child pretty complicated. Our comments on this to Treasury went through a few of the questions I just mentioned, but we also suggested the Treasury consider a very simple rule of using age 26 for everyone other than those who were disabled. I have no idea how they will respond, so keep your eye on that. Now, one set of rules in existing law that is just as important as ever are the see-through trust rules. So let's review these rules. Secure Act didn't change the rules per se, but when we apply them, we're going to get some different results under Secure Act. So first of all, a trust has to meet 4 threshold requirements to be a see-through trust. It has to be valid under state law, it has to be irrevocable, the beneficiaries have to be identifiable, and somebody has to submit the appropriate documentation to the plan administrator or IRA custodian on or before October 31 of the year following death. If you cannot check all 4 of those boxes, you are not a see-through trust. And if you miss the documentation deadline, there's no way to fix it. So any of you that do post-mortem planning and death administration, that should be on your checklist. Now, assuming you check those 4 boxes, now what happens? Well, as a see-through trust, you look through the trust as if trust beneficiaries are designated. Now, why is that significant? Because in another regulation, it says that only individuals can use these RDBs. And estates, trusts, charities, et cetera, are not DBs, and they don't get what under existing law was life expectancy and lifetime distributions and so forth. There is an exception for certain trusts that are see-through trusts, and under that exception, you look through the trust as if the beneficiaries of the trust are designated. And that sounds straightforward enough until you think about something. I'm going to try to do a visual aid on the video here, so bear with me. But imagine I have a whiteboard and I draw a big circle on it. And that's the trust. Now, for each current beneficiary, I put a dot in the middle. And let's say we've got 1 current beneficiary. Now, for the remainder beneficiaries, I put another dot. Let's say there's 3 of those. Now for the alternate beneficiaries, I put another dot. And if our current beneficiary has a power of appointment, there's some debate on this, but most commentators, at least until recently, believed that every possible recipient of that power of appointment needs to be a dot in the circle too. That circle's getting crowded. There's a lot of dots in there. Why is that significant? Because under these rules, we use the shortest life expectancy of all the dots. So you could potentially have 30 family members in there and 1 charity, and that 1 charity will take away any kind of stretch for that trust because charities don't have a life expectancy. And even if you don't have a charity in there, in addition to your younger children, and they may be the lives you want the trust to be able to use, you've got all these other people who are probably older. And if your power of appointment is broad, I don't know what the current population of the world is, but it could approach that number if that power allows you to leave your trust to anybody. I know it's kind of silly almost to think that this is the rule, but it is the rule. So those of us who have been drafting see-through trusts have learned to find ways to manage the dots in the circle. It's kind of artificial drafting constructs that do this that we probably would not otherwise put in the trust. So the most well-known approach, and I'll bet you have all heard of this and probably used this, is the conduit trust. With a conduit trust, you provide that, I'm going to get visual again. So you've got your trust. Actually, let's say that this is the IRA and this is the trust. And the beneficiary to the trust is over here somewhere. With a conduit trust, anytime money comes out of the IRA and it comes in the trust has to pay it out to the beneficiary. It cannot accumulate in the trust. It has to go all the way from the IRA to the trust to the beneficiary. In that trust, you are allowed to disregard all of the dots in the circle except for that one current beneficiary. That's a pretty good way to manage the dots. It's hard to top that. Only problem is, for some beneficiaries, it's not practical to force those minimum distributions out to them. Maybe they're disabled. Maybe they have a special needs trust, and doing that would disqualify government benefits. Maybe they just don't handle money well. So in those situations, we need to manage the dots another way. And if you're really a drafting geek, there are probably at least two or three methods to do this, but I'm going to just cover one because I think that it's the best one most of the time. And that's what we call the age restriction method. And the way that works is you draft your trust, but then you go back and you add a clause, and you work your way through it on the distributions, on the power of appointment if there is, and on the recipients when that beneficiary dies. And you clarify that anyone over a certain age is deemed to have predeceased. You may still have a lot of dots in your circle, but none of them will be older than whatever this age is that you've set as your age restriction. And if, let's say, we're doing a trust for children and there's 3 children in the family, rather than have a separate age for each of the 3, I will normally use the age of the oldest child so that in all the different crossovers and things, we're not excluding the older children in the younger child's trust. So that's kind of a quick run through the see-through trust rules. Let me go on to our next slide. I've seen a couple things cross my desk that didn't quite work, in my opinion. I've seen people try to do a conduit trust like a pot. There's multiple beneficiaries and the distributions have to come out, but the trustee can choose which beneficiary receives it in a certain year. I don't think that follows the regulations. I don't think it works personally. Some other people do, but be cautious on that idea. If you're using it, do your research and make sure you're satisfied that it works from your perspective. One other thing is I've seen some trusts that were intended to be conduit trusts, but only the minimum distributions got forced out. That's not good enough. Any distribution for any reason has to be subject to the conduit clause and always go out to the beneficiary. All right, let's talk effective dates. Anytime you have a new law, you want to know, when does it take effect? So the general rule is any death after 12/31/19 will be subject to the new Secure Act rules. However, if it's a government plan, there's 2 years later, December 31, 2021. Now, when might you see a government plan? You might see that with a university. You might see that with a think tank. You might see that with other government entities that are still under the minimum distribution rules. The reason I say that is sometimes teachers, police, county, fire, et cetera, they have their own plans. They're not even under the minimum distribution rules. But keep your eyes open for that. You may have an occasional client that has a couple of years before these rules, well, I should say the remainder of 2021 before these rules take effect. The fine print of the effective date rules includes a revenue raiser. It's pretty sneaky, in my opinion. It works like this. If I die before the effective date, does Secure Act apply? No. So my 5-year-old son gets that 81-year life expectancy stretch. When the Secure Act takes effect, the life, let's say I died a couple of years before Secure Act took effect, and my 5-year-old is 2 years into this 81-year distribution period. Now that we're under Secure Act, that doesn't change to a 10-year rule. My son still lives out the 81 years. However, under prior law, if my son died early, whoever received the IRA after my son gets to finish off the 81 years. And what this effective date provision provides is no, if my son that's taking under a pre-Secure Act death dies after the Secure Act is effective, my son switches to a 10-year rule. So even on a pre-Secure Act death, the Secure Act could end up applying when that original beneficiary dies. There are a lot of questions on how this works, especially with trusts. Imagine a trust that has multiple beneficiaries and dots in the circle and one of them dies. Does that trigger this? Does it not? We had a lot of questions on this one, and we hope Treasury will provide some clarity. I'm going to show you some highlights of some financial modeling I've done to try to track the economics of different approaches to designating beneficiaries. This is in the materials in more detail, including a detailed description of how I build this financial model and how it operates, some of the assumptions, et cetera. I'm just going to hit the highlights today so we have more time for the case studies that follow. I did a lot of work with these case studies for a Heckerling presentation in 2008. And just to kind of set the stage and get our bearings, this is what the world looked like in 2008. And I did an analysis of a hypothetical individual who was 65 years old, and he was choosing between 7 different strategies. And you'll see a column for each strategy. And he was unmarried with a child 30 years younger. And the first strategy is not recommended, which is distributing the entire plan right now while we're doing the planning. The reason I included that is I wanted a point of perspective to compare the other strategies against something. When we go through the other strategies, you'll see various amounts of benefit measured by how much money that child ends up with at the end of the distribution period. And just to cut to the chase, the stretch out of an IRA is roughly double. That's the 185% column you see in strategy 5. And a Roth conversion at the time of planning is almost quadruple. That's in column 7. Now in the Heckerling, there were dozens and dozens of other case studies, and I took each variable and assumption and I ran it through a wide range of values to kind of stress test each variable. One, to prove, for example, let's say I'd assumed too high an investment yield. Did that mean my results were faulty for others? And what that process did is it showed that these strategies always finished in the same order. The Roth IRA conversion always blew the doors off everything else. The stretch out was next best, and relatively speaking, blew the doors off everything else. And then the other strategies always lined up the same. So that was really helpful. I was pretty confident after doing that I knew which strategies were generally the best strategies. So now let's take a look at the same strategies if we're assuming we have an EDB. Let's just say it's a disabled individual. But we're now in current tax rules. We're now in the Secure Act and so forth. And these numbers are very similar. They're just a little bit toned down. I think the cumulative income and estate taxes are taking a little bigger bite all the way across. But still, they're all finishing in the same order and similar results. Now let's look at all the different, I'm sorry, one other thing on EDBs. Remember that when the EDB dies, you switch to a 10-year period? Well, depending on when they die, it's really interesting to see they get the optimal result if they die a little bit earlier. I guess in this case study, age 78 produces a slightly better benefit where you get the best combination of most of the life expectancy and then a 10-year period added onto it. Maybe that one's a little bit geeky, but I thought it was interesting. Now let's look at the different categories of beneficiaries under the Secure Act and how they do. And there's no surprise here. If you have a non-DB, the ghost life expectancy gives you the least benefit. If you have a DB who's not an EDB under the 10-year rule, you're getting a little more benefit. If it's a minor and that pushes that out a little longer, you're getting more benefit. And if the minor gets an age 26 majority, you're getting even more. If you are a stretch out EDB, now you're getting a lot more. And if it's a Roth IRA conversion, you're blowing the doors off again. What this tells me is maybe we don't get as large a benefit for the planning we do, but we're still getting enough benefit to justify paying attention to this and trying to preserve the ability to get these benefits as an EDB whenever you can get them. So the Secure Act hasn't taken stretch away where we just say we're not going to worry about it anymore. We should still worry about it. We just have to be mindful the stakes aren't as high as they used to be in most cases. I did one other thing. When I was looking at that 2008 case study, the yields looked high to me relative to what I think we're expecting now. By the way, I have no explanation for why the stock market has been doing what it's doing. But I think most investors, as they look forward, are prepared for lower yields than they were in 2008. So I just reran the last slide and I cut the yield in half. Maybe that was extreme. But it was interesting. All the strategies finish in the same order. The curve just wasn't quite as steep as you went from left to right. Finally, I ran a slide if everybody had Roth IRAs, and sure enough, Roth IRAs substantially enhance the benefit for every single category. Now we're going to go to some case studies, and we're going to start with how do we plan for a client who has healthy adult children. So we have Paula is our single parent, one healthy adult child, Pauline. She's got an IRA and other assets. We're not too worried about estate tax. This is really just how does she designate the IRA? But she does ask, what options would prevent my daughter from receiving too much too soon? Okay, pretty straightforward. So let's start thinking about what her options are. At one end of the spectrum, she could designate her daughter outright. The daughter's an adult and healthy. What would be the distribution rule? It would be the 10-year rule because the daughter's a DB but not an EDB. Distribution's taxed to the daughter at her individual rates, and the daughter can certainly leave the assets to whoever she wants. All right, what if we did a conduit trust? How would that work? So Pauline would be the sole DB. The other trust beneficiaries are disregarded, and it could be a charity or other non-DBs if necessary for the others. We still get the 10-year rule. The distributions always come out, thus they will always be taxed to Pauline at her individual rates. We could also give Pauline a power of appointment, and there's no limit on who she could leave them to. And in terms of her getting too much too soon, we could put our own trustee in to at least regulate it for 10 years. If we need more control than that, our next choice would be an accumulation trust. And here it gets more complicated. To qualify as a see-through trust, we're going to probably use an age restriction. Oh, but wait a minute. All DBs get a 10-year rule. Maybe we don't need the age restriction anymore. Maybe we just make sure we don't have any DBs who are or any trust beneficiaries who are not DBs. In other words, no charities. With the accumulation trust, the distributions and accumulations can be handled however Paula wants them handled. The distributions still come out over 10 years. If they're not distributed to Pauline, they're accumulated. Now we're looking at taxable income that's going to be taxed at the trust level, which means compressed rates. So depending on the situation, if the daughter Pauline is not in the top bracket, which seems likely in this case, anything accumulated will probably pay, the tax will probably be paid at a higher rate, which is one consideration with an accumulation trust. And if we're putting a power of appointment in there, our age restriction has to apply to that. Excuse me, not an age restriction. It has to be a DB only power of appointment. You can see I still lapse back into thinking in pre-existing law terms too. It just comes with the territory. Paula listens to all this and says, well, what if I just draft the trust I really want, which is an accumulation, and maybe it has charities, and maybe it breaks the rules this way and that? How much worse is it? Well, it probably isn't much worse. If Paula dies before her required beginning date, this trust would get a 5-year rule instead of a 10. And if Paula dies on or after her required beginning date, this trust would get her ghost life expectancy instead of a 10-year period. You saw from the slides, the 10-year period does give us some benefit. But if it's really rubbing against something else Paula wants, like including a charity in an accumulation trust, I think this fourth option is more viable now than it would have been under existing law, because the penalty under existing law would have been much greater. Now, Paula says, look, you belong to the Portland Estate Planning Council. You and your colleagues have been doing this for 50 years, and you hear all these smart speakers talk every year. You must have a way to beat this, right? There's just some secret way to beat the 10-year rule. No, they really nailed this down. There is no magic way to beat the 10-year rule. It is a new reality under the Secure Act. Now, there is an interesting planning technique that I'm going to mention, and I believe some commentators may represent this as a way to beat the 10-year rule, but I respectfully disagree. This is a totally different planning technique, and it is not a workaround. Having said that, let's talk about charitable remainder trusts. And I'm sure most or all of you know how a charitable remainder trust works. An asset's going to go in. The charitable remainder trust can hold that asset without paying any income tax. And there's going to be a rigid annuity that pays out to the individual beneficiary of that trust. There's a lot of flavors of that annuity, a straight annuity, a unit trust annuity, a net income feature could be built in, or net income with makeup. But at any rate, once it's been designed and drafted, it's completely rigid. But the tax on the IRA distributions is only paid as the distributions come out to the individual. So it really does look a lot like Stretch. However, the complication of operating that trust and the fact that the remainder goes to charity at the beneficiary's death instead of continuing on in the family, I don't think it's fair to call this a workaround on the 10-year rule. It's just a completely different animal. So when does it make sense to use a charitable remainder trust? Well, probably easiest to answer is just when I would not use it. I would not put all of the assets passing to a beneficiary in a charitable remainder trust because the distributions are rigid. And what if something happens where that child needs extra distributions to cover an emergency or something like that? The other problem we have with charitable remainder trusts is one of the requirements for them to be valid is the actuarial value of the remainder has to be at least 10%. And with younger beneficiaries, we're not going to always accomplish that. And so how do you draft an estate plan today when you don't qualify today? There's some very complex drafting involved. So the charitable remainder trust is complicated and not for everybody, and should, in my opinion, should not be viewed as a workaround. The other comment I'll make is whenever we're doing charitable planning for clients, the first question to them should be, if it wasn't for taxes, what would you really like to do? And some clients will say, I really want to do something for charity. Well, that might make them a better fit for a CRT than some other clients, because it is, if you know you're going to do something for charity at your death, it's a pretty tax efficient way to do something. Okay, the case studies will go a little quicker. I spent more time on the first one to set a few things up. So now we're going to talk about Don, a very similar situation as Paula, except he's got 3 healthy adult children instead of 1. So I just summarized all the different ways Don could go. He could go outright to each, conduit trust to each, accumulation trust to each, a non-DB accumulation trust, or he could mix and match different ones for different children. He could do an accumulation pot trust for all 3, or a non-DB accumulation pot trust. And I think it'll be the non-tax factors that will help him decide which of these is the best fit for his children. Now, there's a existing law we still need to keep our eyes on. It's called the separate account rule. And under existing law, let's just say Don was going to designate to 3 conduit trusts for his 3 children. If he designates to his revocable trust, because he knows the revocable trust takes care of that division, he's just walked into a trap. The oldest child's life will govern for all 3. That's not what we want. We want, under existing law, I'm not Secure Act, I'm talking existing, we wanted each child to get their own life expectancy. So the way we would do that is his death beneficiary designation would say, please designate in 1/3 shares to the 3 conduit trusts for my 3 children that arise under my revocable trust. It sounds like a nitpick, but under existing law, it was really important. Well, I know what you're thinking. All those healthy adult kids are going to get 10-year periods no matter what. So this doesn't matter anymore, right? We don't have to do our death beneficiaries that way. I still recommend you do it that way. If we have time, I have a case study later where I get into more detail. But here's, in a nutshell, there's 2 possible advantages if you do it this way that you'll lose if you don't. One is, what if that healthy adult child today is disabled next year and becomes an EDB? Well, if they haven't been designated separately, they're probably not going to get the life expectancy. They'll only get a 10-year rule. The other variation is, what if that healthy adult child is doing well and wants to disclaim? And maybe some of the individuals who would take by reason of the disclaimer are EDBs. Or what if that healthy, well, it's probably not a good example, but you could think of other case studies where maybe that beneficiary might even fall into the less than 10 years younger category. So rather than agonizing over the different options, I just say use the separate account method of designation all the time. It never does harm. It's really a good habit. That's what I would recommend. Okay, let's move on to our next category. We're going to talk about planning for healthy minor children. So we have pretty much the same facts as Paula, but now we've got a minor child, age 3. He's an EDB. He'll get life expectancy until majority. We're a little fuzzy on when majority happens, but probably between ages 18 to 26, unless he becomes disabled. Then he'll switch to 10-year period at the earlier of his death or majority. So we'll step through the options. I'm going to go a little quicker now. Outright is technically an option, but no one's going to designate outright. You'd need a legal guardian. Now, I suppose you could designate to a UTMA. And if you do that, at least in a state like California, where it's possible to make UTMAs go to age 25, I wouldn't do that. All the people who write the rules for the minimum distributions, they think in terms of UTMAs only going to, 18 or 21. I wouldn't push it and go 25 on this case. We could do a conduit trust, but how do you deal with distributions coming out to a 3-year-old if Amy actually died sooner than later? There's no regulation on this, but we think the conduit could be drafted to allow distributions to be made to or for the benefit of the beneficiary. So I think it's a possible option, and that with the conduit, we certainly will preserve the EDB distributions and get them taxed at individual rates. We might go with our accumulation trust, but we have all those considerations we have to remember about to get the 10-year rule. We can't have any non-DBs. So Amy has to choose. If the conduit trust, she can't accumulate. I missed a point. I'm sorry. Let me go back. On the accumulation trust, we do have to worry about more than just non-DBs, because the accumulation trust, we'd like to see that get the EDB status of our minor child. And this is the point I meant to make, and it escaped me. We're really worried we're not going to get that status with an accumulation trust, because our minor child is not the only dot in the circle. We're even worried that if all the dots in the circles are minor EDBs, which would be unusual but possible, I'm still worried we might not get it. We've asked for guidance on this. For planning purposes, until we get regulations, I think you have to assume that with an accumulation trust for a minor child, you're still going to get just the 10-year rule, and you're not going to get the minor child's life expectancy approach. And that puts Amy to this choice. If she goes for the longer distribution period, she can't accumulate. She has to use the conduit trust. If she wants to accumulate, she's probably not going to get the life expectancy until majority method, and the accumulations will get taxed at the trust rates. I'm going to skip over this next slide. Now, Bob has 3 minor children, Huey, Dewey, and Louie. And I think we've covered the things he should be thinking about. He has a number of combinations, and it's important for him to use the separate account rule. Now we're going to go, gets a little trickier now. We're going to talk about planning for disabled or chronically ill. I tried to think of an acronym for the slides. I think I failed on this one. But DCIDBs is what we're using until I can think of something shorter and slicker. So what is disabled anyhow? How is that defined? Well, the drafters of the Secure Act went looking around the code, and they found a definition in 72M7, which has to do with annuities. It's a tough definition. It's similar to what Social Security uses. The person has to be unable to engage in any substantial gainful activity. So if my son is a successful attorney and something happens, he can't practice law anymore, but he can still flip burgers, he is not going to pass this definition. So this is tough. And we have a lot of questions about it in our comments to Treasury, like how do you document this? So there's a lot we don't know yet. And from a IRA custodian point of view, how do they document it? So we're all finding our way on this one. What is chronically ill? Well, they went rummaging around and they found something in 7702B, C2, which is normally used in the long-term care contract area. And you can see that definition here. At least on this one, we know that how it's certified, so that's helpful. Secure Act also adds a couple of additional requirements to this definition, that it's indefinite and reasonably expected to be lengthy. And this definition is going to be really hard to apply to minors because it's written in terms of the skills that someone loses as they get older or go through a disease. And we've asked for some additional guidance and perhaps clarity on how to show that a minor fits this definition. So we're going to talk about Veronica now. And she has an adult disabled child. And there's no question that she meets the definition, et cetera. So we'll go through her options. Well, outright we shouldn't have wasted a slide on outright. There's no way you're going to designate outright to a disabled child. You could do a conduit trust, but the disabled child probably can't handle the money. In most cases, there's some kind of government benefit that is desired, and we don't want to disqualify this disabled child from receiving whatever government benefits they're receiving. So conduit is probably not practical either. That leaves us with the accumulation trust. And you remember the dilemma I mentioned earlier with Amy and her minor child and the accumulation, she'd only get the 10 years and not the EDB status? That seems really punitive now that we're talking about Veronica's disabled child. Is that really how the law is going to turn out? Well, good news. Congress at least figured out that for the disabled and chronically ill, they needed to do more. And at the 11th hour, they added some extra provisions to Secure Act to try to provide for these people. What they added is called an applicable multi-beneficiary trust, or AMBT, or AMBIT. Any trust that has more than one beneficiary, that is a see-through trust, and that all of the trust beneficiaries are DBs and at least one of them is a DCIDB. Any trust that checks all those boxes is an AMBIT. And if it's an AMBIT, it qualifies for two special rules that are not available to trusts that are not AMBITs. And the way the rules are ordered in the statute, I actually find this is easier to explain if I start with the second rule. So under the second rule, if under the terms of the AMBIT, no beneficiary other than a DCIDB can receive any distributions from the plan until all DCIDBs have died, the AMBIT can use the life expectancy method instead of the 10-year rule. That solves it, right? They didn't say whose life expectancy. Probably an oversight. I'm sure Congress intended the DCIDB's life expectancy, but they didn't say it. So we've asked for Treasury to clarify that point. I do think it would be reasonable to plan in anticipation. That's probably what Treasury will say, but isn't that a shame that we don't know and we have to wonder about it until we get guidance? There's just more background here. The takeaway on this slide in the bottom bullet is allowing for the possibility that Treasury might not give us the guidance we're hoping for, which is that we use the DCIDB's life and avoid and ignore all the others. I would suggest the safest approach is to use that age restriction drafting method and try to make the age close to your DCIDB's age, just in case. So even with the uncertainty, it's good news. There's a roadmap. Guidance should be coming. This is a very good thing that got added to the law. Do you remember Bob with the 3 minor kids? I want to come back to him because now his middle child, Dewey, is a DCIDB. And what does that mean for Bob's planning? And there's an interesting planning technique Bob could do. I mean, Bob, if he's an analytical kind of guy, he may say, my IRA is worth a lot more for Dewey than it is to the others, because Dewey would get a life expectancy and the others would not. So what if I leave more of my IRA in trust for Dewey, and then I could leave more of my other assets in trust for the other kids? That's an extra wrinkle for someone in Bob's situation to consider, and it looks like with an AMBIT, that would probably work out. Again, right now, I think we have to use the age restrictions, and we probably have to designate on the death beneficiary. If you write all of this into the revocable trust that, hey, the IRA goes to Dewey, but the designation only shows the rev trust, you're not going to get life expectancy, and you may not even get DB status. So again, we have to use our habit of laying it all out on the death beneficiary designation. There's another interesting rule. Now, this is my segue back to the first of the 2 rules. Under the first rule, if one subtrust is an AMBIT that is going to then divide on the participant's death right away into more subtrusts, each portion of the plan payable to a DCIDB can use the life expectancy method. That, again, they didn't tell us whose life. Hopefully that will get cleared up. What I believe this is going to allow us to do is we could have different trusts for different kids, and the trustee of this trust that receives it and then divides immediately could have some flexibility to make the decision of how much IRA goes where. That's a really new and important planning flexibility that you don't have to commit at the time you fill in the death beneficiary of what percentage is going to go to Dewey. I think this is really interesting. And once we get more guidance on how this rule works, I think this is going to be a very helpful planning tool. Okay, I'm going to skip forward now. I'm still moving because I'm kind of choosing what to cover and still allow time for some questions. The forgotten beneficiaries, this is more detailed discussion of why I think the death beneficiary designations should lay out all of the shares going everywhere. And there's an example here, but in the interest of time, I'm going to step through this. And with the time we have, we're going to talk a little bit about planning for spouses, and then we're going to also take some questions. So let's talk about the traditional family, Ozzie and Harriet. Harriet wants to leave her IRA to Ozzie and then the children. So we know under existing law how we would handle this. Harriet designates Ozzie as the primary beneficiary. Now, Harriet and Ozzie have revocable trusts, etc. Don't designate the revocable trust. Write Ozzie in as an individual on the primary line. That's really important. There are hundreds and hundreds of rulings, private rulings, that people had to go and get because the trust got designated instead of Ozzie. And even though the IRS seems very amenable to issuing favorable rulings, there's no law you can cite that says you get a spousal rollover if you've designated your revocable trust. So don't be that 437th ruling. Get Ozzie written in individually. On the alternate line, then you can designate however you would designate for the children, which might be outright or in trusts or what have you, and you'd have the shares and so on right on your death beneficiary designation, going directly to subtrusts, not going through the revocable trust. Secure Act didn't change any of this, so we're going to handle those issues the same as before. Now, here's traditional family with a twist. Alice wants her plan to benefit her husband and then the kids, but she worries about her husband's money management skills. So what could she do? Well, I think most of you are probably realizing that what we're going to talk about is how could Alice designate a trust for Ted, and it would probably work out best if it's a marital Q-tip trust. So there's some extra complications we have to keep our eye on here. If we want the marital deduction for estate tax, there's some extra language that has to be in that marital Q-tip trust because both the trust and the IRA that's been designated to it have to qualify as Q-tip property. So the trust has to have some clauses in it that ensure that the inside income of the IRA will get treated the same as the other income of the marital trust. Now, you can design this Q-tip to either be conduit or accumulation. Conduit is a much easier trust to administer. There's one problem. If she's trying to balance how much Ted gets and how much is left for the children, and if Ted lives close to or beyond life expectancy, remember, that as a spouse, he's an EDB. He's still going to get lifetime here. Those minimum distributions are going to get really big. And with a conduit trust, there may be much less left for the kids than she'd originally thought. In some cases, some spouses might go with an accumulation trust to moderate that more and only distribute the income and preserve all the principal for the kids. Remember, too, we don't have time to spend a lot of time on this, but if it's an ERISA plan, there are spousal rules that apply. And you can't designate someone other than the spouse without federal waiver and consent. So we've got extra considerations here. This is a much more complicated plan. So now we're going to go to a mixed family got Mike and Carol, happily married. They each brought three children from prior marriages into the family. They want to keep the estate together and provide for the survivor. And then after that, they want to try to get the fairest outcome they can for all six children. So this is a very hard estate plan, especially if the retirement is a significant part of the estate. What are the options? Well, we could do the conduit Q-tip trust, but as I mentioned, the children of the first spouse to die might not get as much as you think with a conduit. They could do a non-conduit Q-tip trust. Any other ideas for them? Depending on your facts, maybe all of more of the retirement could go to the survivor, more or all. If we've got other assets that can go into the Q-tip or bypass trusts. And in community property states, this is even easier because there's certain ways to do non-pro rata and aggregate ownership agreements. Another possible tool is what I call rough justice. You split the IRA into two portions. One gets rolled over to the survivor. It becomes his or hers. The other one goes to the children of that first spouse to die. The efficiency of the distributions working out better will sometimes make that a good choice. Another one not on the slide is the honor system, and attorneys who can sometimes be cynical giggle when I mention this. But I have had clients where they trust each other and the survivor promises to be fair, and the retirement plan is left entirely to the survivor who rolls it over. And in fact, most of the time, the survivor is fair and keeps his or her word. So something to consider if the clients really understand it and are willing to go with that honor system concept. Charitable planning, just some really brief comments. I still think deferral in retirement plans is worth something. So I wouldn't just empty out plans as a default way to make charitable gifts while an individual's alive. But if the individual's old enough to be taking minimum distributions and they don't need them, that's where I think QCDs are a really nice fit. It's a perfect way to move that income off your return completely and help a charity with money that you don't need. Under existing law, sometimes I like to leaving non-retirement plans to charity and the retirement plan to the children because the stretch out was so good. But that game's probably up. So I think after Secure Act, the retirement plan is probably the most tax efficient asset to leave to charity at death. If it's a given, the client wants to make a charitable gift at death. Roth IRAs got a big downgrade in the Secure Act because we don't get that life expectancy. So they're not an amazing deal anymore. They're only a good deal. But when you think about it, they're still worth doing. They're not as good as they used to be, but they're still pretty good. And I like encouraging clients to start young family members on Roth IRAs early. They have to get them a little compensation for them to qualify, but it's a great way to introduce them to investments and to build up a benefit that will be really long-term. All right, I'm going to turn to questions now. Give me a moment to look through some that have come into the chat. And if any of you have questions that you haven't put in, this is a great time to put them in, and I'll try to address as many of the questions as I can. Give me just a moment, please. One question is, in a situation where there's no named beneficiary of an IRA and a custodial agreement defaults to the estate, do I know whether an estate can utilize a dormancy period to defer liquidating the IRAs? And if so, is there a statutory reference? So I think the question here is, let's say that IRA has a 5-year period available. Does the estate have to pull it out ahead of schedule and lose 5 years deferral? Is there a way the estate could get the 5 years deferral? I think there's no special law on this. If the executor of the estate can justify keeping it open, And if the court that has jurisdiction is agreeable to it, I think you could. It just depends on whether that benefit is enough to delay administration. I would guess in most cases it's probably not enough of a benefit, and the estate cashes the IRA out early and walks away from that potential deferral. I have another question to talk more about my concerns on age 25 UTMA accounts. So the reason I made the comment to be cautious with those is the IRS has really looked the other way in this retirement plan area and allowed designation of UTMA accounts as sort of being an equivalent of a designation to something to help protect a minor. And in most jurisdictions, minors reach majority at 18. But, there's certain things, certain adult rights you don't have till you're 21, and the IRS has looked the other way on this age 18 or 21. The IRS has never actually given us any authority on this one way or the other, and I'm not aware that they've ever tacitly approved an age 25. I think personally that's pushing it a little bit, but we don't have any law to guide us. By the way, we did ask for guidance on this point in our comments to Treasury too, and maybe they will provide us some more guidance that will be helpful. So now we've got a question. Bear with me here. The question is, can grandchildren of a Roth IRA owner who is over age 72 qualify as an EDB for future stretch if under age 26? It's not possible because those grandchildren are not the participant's child. So yeah, that one's a non-starter. Oh, I've just turned off my share screen. Let's see if we have other questions here. Here's a question. Can a special needs trust qualify as part of an ambit? Great question. Yes, and I believe that when the ambits were added to the Secure Act at the 11th hour, that was specifically envisioned that would allow you to do a special needs trust, that had they not added it, there would have been no way to do it. So you should be able to do a special needs trust, and it should qualify as an ambit. But there's a couple things you have to watch. Some practitioners draft special needs trusts with a provision that if something changes and the money is interfering with a government benefit, the trust kind of self-destructs and gets distributed out to some other beneficiary named in the trust, so as to not lose the government benefit. That unfortunately would cause the trust to not qualify as an ambit, and then you would not get the deferral. So the trust does need to keep going. It can't have that kill switch built into it. Another thing I've seen in some special needs trusts is it's more of a pot concept, that there's special needs distributions to the one child and distributions are also possible to the other children. That's got to come out. Remember, an ambit only qualifies if no one other than the DCIDB gets distributions, as long as the DCIDB is alive. See if I think I have covered all of the questions that we've received so far. Oh, I'm sorry, I missed one. Since the rules are ambiguous for things like age of majority, what advice would I give clients facing those circumstances before clarifications are made? Well, in some cases, even though the law is unclear, you're going to designate the child and you hope they'll get that benefit, but there's not a lot of choices to agonize over. In other cases, if you're doing an accumulation trust, and we're really waiting for more guidance on that, as I mentioned, you may want to use the age restriction drafting method, which shouldn't need under Secure Act, but it's that way you could argue that your other beneficiaries that could otherwise be older than the one you have in mind don't get counted. Until we get more guidance, that's a precaution that might be helpful. Okay, another question. Any new regulation restrictions at all on the timing of the 10-year rule? We're pretty clear that you could wait until the last day of the 10-year period to take every dollar out and not take a single dollar out before the last day. That part we're clear on. What we're not clear on is whether the last day of the 10-year period will be the 10th anniversary of the death. So if I died today, the end of my 10-year rule would be February 4 of 2032, if my mental math is right. But if they do with the 10-year rule what the regs did for the 5-year rule, instead of February 4 of 2032, it would be 12/31 of 2032. But on either end date, it's okay to wait till the end date to take it all out if that's what you want to do. Next question. If a spouse beneficiary is not a U.S. citizen, do you need to name a QDOT as the beneficiary? I'm going to have to defer on this one. You know, whenever I run into non-citizen spouse issues, I have to kind of run up the learning curve. And if I know that if it's going to be in a marital trust concept, it definitely has to be a QDOT. I think it still could be left outright, but I'm going to defer just because I didn't prepare on that question and I don't know the answer off the top of my head. Well, I've hit all the questions and we have a couple of minutes left. Let me direct your attention. There's 2 more slides in the PowerPoint I'm going to bring up very quickly. And just some drafting tips on, oops, bear with me here. Drafting conduit trusts and accumulation trusts. And there are actually some sample forms in your materials for drafting conduit trusts and accumulation trusts. In the slide, you'll see some drafting points to consider and cross references to section numbers in the sample forms. Some of the interesting things under the 3rd bullet, we believe we can make distributions net of expenses. How else could you pay a trustee fee or any taxes that are charged to the trust, even though there's no authority one way or the other? Remember, you only need that conduit clause while the original beneficiary is alive, so you draft it to stop applying at that beneficiary's death. It's important to limit powers of tax-sensitive trustees. So, for example, child disclaims and trust goes to grandchild and child is a trustee. We don't want the child having too much power over the trust. We only want the conduit provision apply to those plans where we're getting a benefit. So we define a term, DB eligible retirement account interest. And we limit future changes. So for example, there's a carve out on any ability to modify or to can't or that kind of thing. And then we address how debts, expenses, taxes are charged. Then on the next slide, some drafting tips for the accumulation trust. I think it's a good idea to include a statement of intent. And I would put some restrictions on the powers of appointment. You'll see those in the clause. Oh, that's the other thing I meant to mention. As we worked on this task force to give comments to Treasury, I've had a pet issue over the years, and I've kind of kept my voice down because almost all commentators believed under existing law that any potential recipient of a power of appointment counted as a dot in the circle. And I've been kind of a lone voice in the woods. I've felt that never made sense to me. They shouldn't be counted because those recipients have no beneficial interest. They have no standing to take action against the trust. They have no standing to get accountings, et cetera. Well, our task force kind of came around and embraced that point of view and presented it as part of the comments to Treasury, asking them to consider clarifying that these permissible recipients don't count, or if they do count, at least clarify that they do. So keep your eye on that. That could be a very interesting development. Coming back to the slide on the drafting, you'll see that the trustees required to track accumulations. And there's a few other good points here, but I also realize I've hit the end of my time limit. Thank you so much for joining this today and giving me a chance to talk to you. And if you do have questions later, please feel free to email. Thank you very much and have a great day. Enjoy the rest of the program. Bye-bye.
I hope you've all enjoyed today so far. My name is Sean Duberg, Director and Senior Private Wealth Advisor with Union Bank. Union Bank has a long history of supporting the Estate Planning Council of Portland. Once again this year, we're proud of our ability to be a gold sponsor of the Estate Planning Conference. Union Bank is also proud of the nearly 140 years of helping individuals, families, businesses with all of their financial needs and matters. Today, I'm very pleased to introduce our next speaker, Laura Howell-Smith. Laura Howell-Smith is a Managing Director in Washington National Tax at Deloitte Tax LLP Family Wealth. Laura has extensive public accounting experience, specializing in transactional and compliance issues concerning S corporations, trusts, estates and gift taxation, passive losses, net investment income tax, and qualified small business tax exclusion. She is the Washington National Tax Section 199A leader. Laura also has significant experience working with private letter rulings and other Internal Revenue Service relief requests for clients. She previously worked for the IRS Office of Chief Counsel of Pass-Throughs and Special Industries, where she drafted regulations, private letter and revenue rulings, and revenue procedures in the areas of gift taxation, income taxation of S corporations, partnerships, trusts, and estates. She is the Washington leader of the Deloitte Tax Cryptocurrency Working Group. Laura is a past chair and a current member of the S Corporation Committee of the American Bar Association Taxation Section and of the American Institute of CPAs S Corporation Tax Resource Panel. She has written numerous articles for national tax publications and made several presentations for national tax forums, such as the ABA Tax Section, American College of Trust and Estate Counsel, and AICPA Estate Planning Conference, and USC Tax Institute. She is the co-editor of the Federal Income Taxation of Passive Activities Treatise. Laura holds a BA from the University of Southern California, a JD from University Boston School of Law, and an LLM in tax from Georgetown University Law Center. Today, Laura will present on estate planning for S Corporation shareholders. Welcome, Laura.
Good afternoon or good morning, everyone. As indicated, I'm here to talk about S corporations and estate planning. I will be going through a number of items. The agenda for today on the next slide, and I apologize, I had a problem with my slides. The agenda today, we'll talk about some general considerations for S corporations, then talk about some pre-mortem planning dealing with trusts and ways to limit transfers involving buy-sell agreements and cross-purchase agreements. And then the second part, we'll discuss pre-mortem planning ideas and techniques and things that should be considered. So let's talk about some permitted trust items. And one of the things dealing with S corporations that is important to know in dealing with trust is that there are only certain types of persons who are eligible to be shareholders of S corporations. One, the person, there's an individual, the individual has to be a U.S. citizen or resident. The certain estates can be shareholders. If it's a trust, only certain types of trusts that can be shareholders, and I'll be talking about that shortly. Also, one of the things to consider with estate planning with S corporation is that S corporation cannot have more than 100 shareholders. Also, the S corporation can only have one class of stock. It can have voting and non-voting, but it cannot have preferred stock or special allocations. And so, as the next slide shows, there's some other items to think about that when a shareholder dies, it is important as advisors that we inform our clients that the S corporation status is very important. If the person holding the S corporation stock is not an eligible shareholder, then that will disqualify the corporation's S status. It will terminate, it will become a C corporation, and it will affect not only the person holding the stock, but also all the other shareholders. So one of the other items to consider is that when a person dies or before they die, think about transitioning the ownership of the stock held by that individual. In terms of shareholder eligibility and planning around that, we can plan and talk a lot about reducing income taxes, gift taxes, and estate taxes, and planning with S corporations and their shareholders. Also, S corporation can have charitable organizations as permitted shareholders. So many times our clients have charitable goals, and that can be accomplished with S corporation stock. There are certain issues around that has to be taken into account. Also, with estate planning, we can set up holding the stock so you can avoid probate. So with the next slide, let's talk about the types of trusts that can be S corporation shareholders. S corporations can have grantor trusts as shareholders, but only certain types of grantor trusts are eligible shareholders, and I'll talk about that shortly. S corporation can have testamentary trusts. These are trusts that are set up under a will, and they come into being at the date that the personal representative of the estate actually funds that trust, and that trust is going to be a permitted S corporation trust for 2 years from the date of funding. The next type of trust is a voting trust. This is something that's usually used in businesses and not for estate planning purposes. The next type of trust is a qualified subchapter S trust, or otherwise known as QUIS. And the last type of trust that is eligible to hold S corporation stock is an electing small business trust, or ESBIT. So with respect to trust considerations, well, we want to make sure that it is important that the trusts are permitted as corporation trusts. Again, if any trust is holding S corporation stock and is not an eligible trust, then it's going to affect the corporation's S status. Many times also, once a trust is holding the stock of S corporation, there's a need to monitor what's happening with that trust to make sure that everything that trust continues to be a permitted S corporation shareholder. So the next slide goes into a grantor trust. I indicated that only certain types of grantor trusts can be S corporation shareholders, and this is provided under Section 1361C2 Cap A, Cap A1 of the code, and all S corporation trusts must be domestic trusts. Then the type of grantor trust that qualifies is a trust, all of which is treated as under subpart E of subchapter J as owned by one individual who must be a U.S. citizen or a resident. But note here that husbands and wives are treated as one person. Also, if the deemed owner of the trust dies, then that trust is going to continue in existence and be permitted for up to 2 years. But we're going to talk about a little bit more about that later. Next slide. So with a grantor trust, we know that there are certain provisions under subpart E of subchapter J that will make that trust for income tax purpose a grantor trust, and of which the grantor trust tax rules will apply. And many times it is going to be important to have more than one grantor trust power in the trust to ensure that the trust is a qualified grantor trust for subchapter S purposes. Now, common grantor trusts that we deal with all the time in estate planning are the revocable trusts, Many times, husband and wife will set up a revocable trust, and as long as that trust is the deemed owner has a right to revoke the trust with respect to the entire trust, then that trust is going to be a permitted S corporation trust. Another type of grantor trust that we deal with a lot in estate planning is the intentionally defective grantor trust, or the IDIT. With the IDIT, this also is a grantor trust. We know how it is funded. A gift is made first to the trust, and then many times stock will be sold to the trust. The next type of familiar grantor trust in estate planning is the grantor retained annuity trust, or the GRAT. Again, this is another type of situation. Okay. When there's a grantor trust and the deemed owner dies, then it's important to ensure that that trust continues as a permitted shareholder. Under Section 1361 C2 Cap A 2 little I, that grantor trust, if it was a permitted grantor trust during the life of the deemed owner, then it will be a permitted trust for subchapter S purposes for 2 years up to from the date of death. And thank you. And after that 2-year period of time, the trust will cease to be an eligible shareholder, and either the trustee is going to have to distribute stock out to an eligible shareholder, or if under the terms of the trust, it qualifies as a qualified subchapter S trust or electing small business trust, a timely quist or SBIT election needs to be made. The next slide, please. Now, if you have a grantor trust and the grantor doesn't die, but this trust ceases to be a grantor trust, because many times a grantor will release their powers under the terms of the trust that makes it a grantor trust, then that trust ceases to be a grantor trust, becomes a non-grantor trust, and it immediately must qualify as otherwise an S corporation permitted trust by making a timely SBIT election or quest election. That election has to be made as of the date that the trust ceases to be a grantor trust. Okay. The next slide. Some other items to think about with respect to grantor trusts. We many times we have trusts of which the beneficiary has a right to withdraw contributions to the trust, or if they reach a certain age. And if the settlor of the trust is not otherwise treated as the grantor of the trust, then that beneficiary may be treated as a grantor with respect to all or a portion of the trust under Section 678. But these type of powers are such that we have to be mindful of them, because this type of trust may be a partial grantor trust and not a full grantor trust. And a partial grantor trust does not qualify as a permitted grantor trust unless a SBIT or a quest election can be made. Another thing to think about is that many times if our client has a revocable trust and they die, then that trust can qualify to be treated as part of the estate when the personal representative of the estate and the trustee make a Section 645 election. When a Section 645 election is made, then the trust is treated as part of the estate, and the estate is treated as a shareholder for subchapter S purposes, and that trust will be the estate will be a permitted S corporation shareholder for the entire period of the Section 645 election with respect to the trust. Next slide, please. So the next type of trust we're going to talk about is qualified subchapter S trust, or QIS. Now, this came about, Congress first allowed QIS in 1983, and this is after advisors and planners complained about the inability to do more things with through estate planning with trusts. This grantor trust was believed to be not enough. They wanted to do something else. So they allowed this type of trust. Now, this type of trust is unique to S corporations because this is a trust. Is taxed a certain way, and it must include certain terms. Under the terms of the trust, it can only be one income beneficiary during the lifetime of that current income beneficiary. If any distributions of principals are made under the terms of the trust, the distributions must be made only to that beneficiary. If distributions are made to anyone else, then the trust is not going to qualify as a quist, and it'll be an ineligible shareholder. Also, the current income beneficiary's interest, if it terminates if during the life of the income beneficiary, then all the assets in trust must be distributed to that beneficiary. If it's otherwise, the trust is not going to qualify. Also, the quist requirements, and this is under section 1361D of the code, the terms of the trust must either require that all the trust accounting income is distributed out, or if the terms allow a discretionary distribution of trust accounting income, the trustee must in fact distribute out trust accounting income. Now, if the terms are not mandatory and they're discretionary, then that means on an annual basis, we must monitor the trust to make sure that the trust accounting income is in fact distributed out to the income beneficiary. Because if it's not, then the trust ceases to qualify as a quist, ceases to be an eligible shareholder, and the corporation's S status terminates. So it's really important to monitor this. Also, what's important about the qualified subchapter S trust or quist is that the income beneficiary must make a timely quist election. Okay? By making this election, the income beneficiary is agreeing to be treated as a Section 678 grantor of the trust with respect to the S corporation stock, even though in fact the income beneficiary under the terms of the trust may not be a 678 owner, but by making the election, they're a deemed 678 owner. Also, whereby the income beneficiary is treated as a shareholder. If the income beneficiary dies during the term of the trust, then this is another area that we must monitor. So to ensure that the trust continues in existence, if the trust continues in existence, but it does not qualify as a permitted trust, a grantor trust, and SBIT, and it ceases to qualify as a quist, it ceases to qualify as a quist, then the trust is not going to qualify, but it's going to be a permitted trust for 2 years. Next slide, please. Let's talk about some other pre-mortem planning and buy-sell agreements. Many times corporations and other business entities will have buy-sell agreements in place, and these are allowed also for S corporations. And S corporations, the type of buy-sell agreements that are in place, there are corporate redemption agreements, cross-purchase agreements between shareholders, and you can have both a redemption agreement that also includes a cross-purchase agreement. Okay, next slide. So with buy-sell agreements, it's important, it can be important for estate planning purposes because if the buy-sell agreement terms are set up in a correct way, or pursuant to the rules under Section 2031 and 2701 of the code and the regulations, then the value established under the buy-sell agreement will be respected by the IRS, so that if the value under the buy-sell agreement is less than the fair market value, then that is the amount that will be includable in the gross estate. If the value of the if certain rules are not met under Section 2031 and 2701 of the code, then the buy-sell agreement terms will not be accepted by the IRS. And even though, and this next slide shows, and the next one, please. So if the buy-sell agreement does not, in fact, so this is something that has to be monitored by the advisors. That if they want, as the next slide will show, if the advisor wants the provisions to be respected by the IRS, certain requirements have to be met. We'll talk about those shortly, but by having a buy-sell agreement in place, it will create estate liquidity because the corporation will redeem the stock or the other shareholders will purchase the stock from the estate, so that the estate will have the cash to pay perhaps any estate tax that will be due. Okay. Now, under the Section 2031, the regulations -2H, it sets out, and this has been handed out in a number of court cases. It sets out what provisions are necessary for the IRS to accept the terms of a buy-sell agreement and the value set up in a buy-sell agreement. And these are the terms. The obligation to offer to sell has to be an obligation to offer the sale at death. It has to be, the price has to be reasonably ascertainable. The agreement must preclude a lifetime transfer of being higher than the amount that's offered for at death. So, for instance, if the value of the stock is set in the agreement for estate at the death of a shareholder is $100, but before death, if the regular price is higher than $100 under the buy-sell agreement, then this is something the government will not accept as establishing the value of the stock at death. Also, the agreement must have been entered into for a bona fide business purpose. So it cannot be just a device to pass on property without to the heirs of the decedent. Next slide, please. As I indicated, if these conditions are not met, then the IRS is not going to accept them for establishing the value of the state as stock for estate tax purposes. Even though this agreement is going to be a legal agreement, and you could have a situation in which the corporation must redeem the stock for the value set under the buy-sell agreement, but the government will include the stock in the gross estate at the fair market value, and if the fair market value is higher than the date of death value, then that is going to be a problem for the estate. Okay. Also note that buy-sell agreements that are entered into or modified after October the 8th, 1990, they must also meet the requirements under Section 2703 and the regulations thereunder. Under these, and as the next slide will show, these requirements are similar to the requirements under the 2031 court cases, but basically there must be a business purpose. There must be a compatibility that the value of the stock under the buy-sell agreement has to be basically market rate. Okay, next slide, please. So one of the things to consider with buy-sell agreements that are unique to S corporations is that I mentioned earlier that an S corporation cannot have more than one class of stock. There are provisions under Section 1361 of the Code and Regulation that talk about buy-sell agreements and whether or not they're going to create a second class of stock. And as the next slide shows, under this provision, there's the general rule that a buy-sell agreement will be disregarded and not treated as a second class of stock unless there's a principal purpose of the agreement to circumvent the one class of stock rules, and it's a two-pronged test. The agreement established a purchase price that is significantly above or below fair market value. Fortunately, for estate planning purposes, there is a safe harbor that if you have a bona fide agreement that's put in place and it is for death, disability, divorce or termination of employment, then the purchase price set in the buy-sell agreement is going to be disregarded. So for subchapter S purposes, this is not going to be treated as a second class of stock. Now, one of the other things that we have to keep in mind is that about the consequences of a redemption. How is it going to affect the corporation? How is it going to affect the decedent's estate? Here, if it's and it depends on whether redemption qualifies for sell or exchange treatment under Section 302, or if it fails seller treatment under Section 302, then it's going to be treated as a distribution under Section 301, which is basically going to be treated under Section 1368. So as the next slide shows, now the consequences of a redemption, the effect to the shareholder's estate. If it's a 301 redemption, then as I indicated, it's going to be treated as under Section 1368 under the normal S corporation distribution rules. So the redemption is going to be tax-free to the estate to the extent of the corporation's AAA account, that's accumulated adjustment account, in the shareholder stock basis. Redemption is qualifying for so the consequences of a redemption for the corporation is that it's going to reduce, if it's a seller exchange treatment, then it's failed seller exchange treatment, it's treated under Section 1368, the regular subchapter S rules, then it's going to reduce the corporation's AAA amount by dollar for dollar. If it qualifies as seller exchange treatment under Section 302 or 303 of the code, then the corporation's AAA account, that's the accumulated adjustment account, will be reduced proportionally. So that if the corporation has, and this is something to be mindful with the redemptions, is that if you have a corporation that has a AAA account and it also has an accumulated earnings and profits account, and the distribution is treated, it fails seller exchange treatment, and it's going to reduce AAA to the extent of AAA, and any amount in excess of AAA is going to be treated as coming out of accumulated earnings and profits account and be taxed as a dividend. So and once it's taxed as a dividend, then it doesn't matter what the shareholder's basis is, it's going to be taxed as a dividend under the current dividend rates. Next slide, please. Let's talk about funding buy-sell agreements. How does a corporation fund a buy-sell agreement? They can fund the buy-sell agreement through life insurance, by getting life insurance on the key person, and upon the death of that person, the corporation will receive the life insurance proceeds and be able to redeem the stock that way. The corporation could also finance the redemption by obtaining debt from a third party. By obtaining debt, one of the things we want to watch out for with debt is that debt could create a second class of stock if it's not treated as debt under general principles of tax law. Or note that there is a safe harbor for debt under the straight debt safe harbor rules. And the next slide shows the requirements for straight debt safe harbor. Under these requirements, to have straight debt, then this is a written unconditional obligation that it cannot have an interest rate or payment that is contingent on the profits of the corporation, and it cannot be convertible into stock. The creditor must be an individual, cannot be a non-resident alien, because non-resident alien is not a permitted shareholder. It can be an estate or a certain type of trust, or any person who is actively and regularly engaged in money lending services. If you meet these requirements, even if the debt is treated as equity under general principles of tax law, if you meet these requirements, then the safe harbor applies and the debt will not be treated as a second class of stock, and that preserves the corporation's S status. Okay. Next slide, please. The other type of agreement could be a cross-purchase agreement, and this is an agreement that's put in place between the shareholders, that they will, if one shareholder dies or retires, the other shareholders can purchase the stock. The advantage of a cross-purchase agreement is that the person purchasing that stock will get a cost basis in that stock for purposes of the other subchapter S purposes, and in terms of the flow through of income, what happens on the disposition, or and also the ability to take losses. Okay. But all those subchapter S requirements are beyond our presentation today. But if you have any questions, I'm here to answer them. Let's talk about some other planning, pre-mortem planning. Say you have a corporation and the shareholder only, and the corporation only has voting stock in place. And our client, the shareholder, wants to do estate planning, or wants to do some type of estate planning, but they don't want to release the power or control of the corporation. One of the things that can happen is the corporation can have a recapitalization and have voting and non-voting stock. Then our client can take the non-voting stock and transfer that non-voting stock to others outright or in trust. Okay. One of the issues with having outright gifts is that many times our clients do not want to lose control. And if they make outright gifts of voting stock, they may lose that control. Also, there are issues around minors holding stock, only not tax issues, but issues in the sense that our clients want to make sure that many times they want to make sure that their child is competent in being a minor. They may not be. And many times in this type of situation, the client will transfer the stock into a trust and not outright. Also, gifts of stock can qualify for the gift tax annual exclusion amount. You can also use your lifetime exclusion amount to the extent of any gift tax that exceeds the gift tax annual exclusion amount. Also, with respect to making gifts, we keep in mind that certain discounts can apply. Lack of control, minority interest can apply as well. So let's talk about some post-mortem planning. Okay. With post-mortem planning, say we have a situation where our client who holds S corporation stock dies. Well, as advisors and consultants, we want to make sure that the S corporation doesn't lose its S corporation status. So what happens to that stock is very important. We have to make sure the stock is transferred, goes ultimately to an eligible shareholder so that the corporation S status stays in place. Also, we want to make sure that if the stock is redeemed, that the corporation has enough accumulated earnings account, and the effect to the corporation's accumulated earnings account, the AAA and any AEP, they are going to be affected upon the death and any redemption. So we have to be mindful of that, of the stock. So one of the items to keep in mind is that if we have a shareholder of an S corporation that has a controlled foreign corporation and owns more than 10% of that foreign corporation, then under the Tax Act of 2017, the TCJA, they enacted a new section 965, and under this provision, basically any accumulated income of that CFC was immediately tax. Before it was accumulated, it was considered offshore, and taxpayers did not have to pay a tax on it. But under the TCJA, Section 965, all of a sudden there's a tax. And S corporations can have CFCs, and its shareholders may have had this issue. So the next slide shows, okay, that there are two provisions that our shareholders may have used during their life that we have to be mindful of when they die. First, if there was a tax imposed and the shareholder agreed to pay the tax, and they could have made an election to pay the tax in installments. One of the things that's important is that the death of a shareholder will not accelerate the installment payments. And that's very important and very helpful. The other provision is Section 965I, and this provision is unique and special only to S corporations. It's a fantastic provision. It's quite interesting that no other taxpayer was able to get under TCJA, and that is an S corporation shareholder of a S corporation that had a CFC in place and had an assessment of the accumulated income from the CFC to pay a tax. That shareholder could have made an election under Section 965I to defer the payment of the tax. Okay? And unless until there is a triggering event. And many times, if there's not a triggering event, then the tax may never be paid on that accumulated income attributable to that shareholder. And so what is a triggering event? The next slide shows that you can have a triggering event. A number of things will be a triggering event, but note here that the death of the shareholder is in fact a triggering event. And that triggering event will cause all the tax to be immediately paid. And that can be horrendous, but there's an exception that can apply. If the decedent's estate enters into a transfer agreement, the estate can inherit that deferral treatment of the payment of tax. And that agreement has to be entered into in a certain period of time. And basically the due date is the latter of the unintended due date for the final income tax return. If you miss that date, the tax is going to be due, and that's going to be maybe a tremendous tax for the estate. Also note that if a transfer agreement is appropriately entered into, and during the estate administration or after the estate administration, the stock is transferred to another person, if they want to continue the deferral period for the payment of the tax, then the estate and the transferee will have to enter into another transfer agreement. And under this transfer agreement, then the estate and the transferee agree to continue to be on the hook for the payment of tax. Also notice for 965I purposes, if the election is made, it puts also the corporation on the hook. The corporation is jointly and severally liable for the tax. So you don't get away from the tax, but it can be a very long deferral period. So another consideration when a decedent dies is the estate. If the decedent holds stock outright when they die, then it's going to pass to the estate. And we talked about who are the eligible shareholders of the S corporation. Well, an estate is in fact an eligible shareholder, but it's an eligible shareholder for the entire period that it is reasonable for the estate to be open. There's a revenue ruling under which the estate is open for 6166 purposes, and that was considered reasonable. No, I talked about this and mentioned this earlier, that if the stock is held in a qualified revocable trust, then a Section 645 election could have been made. And for that period of the Section 645 election, the estate is treated as a shareholder. And after the estate ceases to be, the Section 645 election ceases, then the trust is going to be a permitted trust for another 2 years. So that's another item or consideration for planning for the estate of a S corporation shareholder. Next slide, please. One of the other things to consider is basis step up, or basically for stock that is included in the decedent's gross estate, then it's going to be included. If the buy-sell agreement doesn't apply to set the value, then it's going to be included at the fair market value of the stock. And that it could be good, because if it's the fair market value increases, is say when the decedent died, the adjusted basis of their stock was $50, but the fair market value of the stock is actually $100, it's going to be the basis of that stock will be stepped up to that $100, and that will allow for more tax-free distributions from the S corporation to the shareholders, and also it increases the ability to take losses as well, and that is always good for any type of shareholder. They will always need more basis for just to get tax-free distributions as well as losses. Also note that this basis step up applies to the stock. It does not apply to the inside assets of the corporation. There is no sections similar Section 754 election that applies to partnership. S corporations do not have this benefit. Also, we have to be mindful that if the corporation sells significant assets in the year of death, and then it liquidates in a later year, you can have a different, you can have a situation where there could be a large capital loss upon termination. So it's always helpful that if the corporation is going to sell assets, that they liquidate in that same year. Okay, next slide, please. So another item to be mindful of is the ability to close the books. Generally, under the rules under Section 1377 of the code, shareholders have to take into income losses and all tax items on a per share per day basis. And if a shareholder dies mid-year, then they still have to take into account the tax items attributable to that S stock on a per share per day basis, even though they may not be, obviously they're not a shareholder on the latter part of the year. And so that may not be beneficial for the decedent on his last return and the estate. So one of the opportunities is the ability under Section 1377A2 to close the books. And instead of taking the tax items on a per share or per day basis, you take the tax items for the decedent and the decedent's estate. It is treated as if the tax year closed as of the decedent's death. So all tax items attributable to the S stock held by the decedent are taken into account just up to date of death. And anything that happens after date of death doesn't have to be reflected on the decedent's last income tax return. And whether this is beneficial or not will depend on a number of facts. For instance, if the corporation has a sale of assets that increases the basis of the shareholder stock at the after death, well, in the decedent can't really use those that increased basis of the stock. Maybe it's best to have a closing of the books, and so all of that gain on the sale of the assets will be attributable to the stock held by the estate after death. Next slide, please. Also, as estate planners, we are familiar with we're familiar with deferral of the estate. The states can have a tax year other than a calendar year, but an S corporation typically has a state has a calendar year. The difference between the ability to play around the tax year, the difference between the tax year can be beneficial. Next slide, please, because I am running out of time here. Next slide, please. Okay, income in respect of decedent is something else that has to be taken into account. Any income in respect of the decedent with respect to the S corporation stock is going to be taken into account, and so we just have to be mindful of it. Next slide, please. Also, 469 losses. Certain 469 losses can be taken on the decedent's last return to the extent of any step up. If the estate has any suspended losses, those suspended losses are going to be added to the basis of the stock at the end of when the estate distributes out the stock. Next slide, please. Okay, I think this is our last slide, and this is about charitable giving. Obviously, we're not going to talk about all of the aspects of charitable giving, but note that S corporations can, in fact, have charitable organizations as eligible shareholders. But note, all income and gain that passes through is going to be unrelated business taxable income. Most charitable organizations do not want that type of situation, so there needs to be planning around that. I think that my time is up. Are there any questions? Okay, we do not have any questions. I appreciate your taking the time to listen, and if you need to get in touch with me, my information is in the slides. Thank you.
welcome back. We hope you enjoyed your break and perhaps were able to visit some of the sponsorship booths. My name is Mary Lago, and I've had the pleasure of serving as a board member for the Estate Planning Council of Portland for the last 10 years. Tomorrow marks my last day as immediate past president, and it has truly been an honor to serve alongside the many volunteers who bring leadership to the organization. Today, we want to offer a special thank you to the annual seminar committee, who's had to pivot in ways they never imagined in order to bring us this all-star lineup of speakers in a virtual format. Thank you so much. Well, I'm here today in my role as Executive Vice President and Chair of Wealth Management for Ferguson Wellman. Ferguson Wellman is a registered investment advisory firm that was formed here in Portland, Oregon in 1975. We've continued to grow and ended last year with $6.85 billion in assets under management. And through this time, Ferguson Wellman has formed a really special relationship with the estate planning community because of the approach we take to managing clients' wealth. We don't just focus on generating returns, but also on preserving and protecting those returns through proper planning in collaboration with our clients' tax and legal advisors. And we are delighted today to have the opportunity to support the estate planning seminar for the 31st year. And one of our traditions at this event, as you may know, is our Predict the Dow competition. We ask you to guess where the Dow Jones Industrial Average will be when the closing bell rings on the last business day of the year. And generally, we identify a lovely place somewhere in Oregon or Washington to send the lucky winner. But this year, we're opting for maximum flexibility, and the winner will receive a $500 gift card to Airbnb. So if you'd like to register your prediction, please visit us in our virtual booth. Well, let's get on to the winner of last year's Predict the Dow. We had 47 submissions. Our most bullish response was 42,831, and our most bearish response was 76. Quite bearish indeed. Well, on December 31, 2020, the Dow Jones Industrial Average closed at 30,409.56. So the most accurate response was submitted by Elizabeth Menz, who correctly predicted a 9.7% return. Congratulations, Elizabeth, and we will be coordinating delivery of a $500 gift card to Heritage Resort in Walla Walla for your future enjoyment. It is now my pleasure to introduce our next speaker, Sam Donaldson, who will provide us with a federal tax update. Sam is a professor with Georgia State University College of Law, and prior to joining GSU, he was on faculty at the University of Washington School of Law in Seattle for 13 years, where most of us came to know and love him. But during his tenure at University of Washington, he was a 5-time recipient of the Philip A. Troutman Professor of the Year Award from the School of Law's Student Bar Association. He also served 2 years as Associate Dean for Academic Administration and for 6 years as the Director of the Law School's Graduate Program in Taxation. Professor Donaldson teaches a number of tax and estate planning courses, as well as courses in the areas of property, commercial law, and professional responsibility. He is an academic fellow of the American College of Trust and Estates Council and a member of the bar in Washington, Oregon, and Arizona. Among his scholarly works, he is co-author of the popular West Casebook, Federal Income Tax, A Contemporary Approach, and co-author of Price on Contemporary Estate Planning. He has served as a Harry H. Harrow Visiting Professor of International Law at the Northwestern University and a Visiting Assistant Professor at the University of Florida Levin College of Law. Today, he returns to our annual estate planning seminar to bring us this year's federal tax updates. Welcome, Sam, and thank you for joining us.
Thanks very much, Mary. Is this where I confess that I'm the guy who predicted 76 in the Dow prediction contest? You can call me a bear all you want. They call me that on a few apps too, but whatever. Hi, everyone. It's great to be able to, I guess, see you again. Luckily for you, the camera only goes one way, so I can't see you wearing the pajamas or the cutoffs that you have on to enjoy this morning's presentation. Just as if we were still meeting in person, though, our goal for this session is to recap all of the big cases, rulings, regulation, and most certainly legislation from the last time when we were together in person, which feels like, what, 15 or 20 years ago now? Like so many other people, I'm desperate for the opportunity to be able to attend a live conference again. I so look forward to the time when we can all just stand around some really bad coffee and stale pastries and see each other face to face. Hopefully it will happen for us next February meeting in downtown at the Hilton. But until then, there's certainly an awful lot for us to talk about by way of some developments. You remember the old Chinese curse, may you live in interesting times. Well, the Chinese really know their curses, don't they? Because this past year has been a most interesting time for us on all fronts, and particularly from a planning perspective. The uncertain environment in which we currently find ourselves presents some unique planning opportunities for our clients, but we need to understand where they're coming from and what those factors are. Certainly, the pandemic has wreaked havoc upon the economy. And as a result, many of your clients find themselves with asset portfolios that might look a little smaller than where they were this time last year. Some investments in the stock market have been great, but perhaps they've witnessed other assets really suffer. And for your clients who've had closely held businesses, the past 12 months has probably been indeed quite the steep challenge. At the same time, we're looking at really record low interest rates. It seems like for the last several years, all we've kept saying is interest rates can't get any lower. And yet the interest rates have been getting lower. Well, they really can't get much lower than they can right now unless such a thing as negative interest starts to come into play. So that makes some strategies maybe a little bit more intriguing than they would be normally. The same token, many of your clients find themselves in a lower income tax bracket, at least they did in 2020, probably entered 2021 optimistic that it would be better than last year. And while it may be, still, many of the leading economic forecasters are indicating it's really going to be until 2022 before we start to feel like normal again in our economy. So it might well be that some of your clients who are right now in the midst of preparing 2020 returns that show them in lower brackets could still be in those lower brackets for 2021. Plus, at the same time, we can't ignore the fact that you've probably been dealing with substantially more probates and estate administrations than you normally do, just because of the higher death toll that has been involved in the pandemic and then related access to healthcare because of the pandemic, even for people who aren't dying necessarily of COVID, but because resources being as strained as they are, it's been accelerating some deaths for some clients. The same token, though, of course, we have brand new control of the Democratic Party for 2 of the 3 branches of government. And that has some of your clients all a Twitter and not in the social media platform sense. Worried that there could be changes that are forthcoming to the Internal Revenue Code, and perhaps some of those changes could be made retroactive. What sorts of strategies are still available on the table for the clients who didn't act at the end of last year? So there's certainly an awful lot for us to be able to talk about here in our time together. Of course, we'll start as we normally do with just a short look at the tax brackets that are in play for this year for individuals as well as trusts and estates. I think it's important that we spend a little bit of time talking about some provisions in the Consolidated Appropriations Act, this massive bill from Congress that was passed and signed in December contained 2 separate pieces of legislation affecting the Internal Revenue Code, in particular, some income tax planning for clients that I think everybody needs to make sure we're all on the same page about and understand. Of course, while most tax update presentations look in the rearview mirror about what happened in the past 12 months, what's on the minds of a lot of planners and their clients right now is what might be coming up ahead in the course of the next 12 months. What does a Biden tax plan really look like? What are the details that we might be able to ascribe to it? And what are the chances of that legislation coming to pass? In light of where we find ourselves with the current tax laws and where tax laws may be going, we'll also spend a little bit of time talking about what planning techniques might particularly make sense in this current environment. What the cool kids are talking about with their clients anyway. And to the extent that we have any time left over before you've long tuned out and gone to lunch, we'll see if we can squeeze in any other developments as well. But The good news is you already have access to the written materials that give you a written summary of what I consider to be the big developments over the course of the last 12 months. So to the extent we don't have time to be able to cover them here this morning, you'll at least have those written materials as a permanent resource to help you with any insomnia problems from which you might be suffering. All right, let's get into it and take a look at the forthcoming, the 2021 income tax brackets. We will start with the federal income tax brackets for individuals, for both unmarried taxpayers and for married couples filing a joint return. Give you a moment, as always, to ego surf the chart and cry at the small bracket that you might find yourself in here, at least for this year. This chart uses a format that we've used for this purpose for a few years now at this conference, because it tells us not only the tax rates applicable on ordinary income, but also the rates that apply to adjusted net capital gain and qualified dividend income. Heck, even in the lower right-hand corner there, you can see the 3.8% net investment income surcharge, which continues to be a function not of a taxpayer's taxable income, but instead a taxpayer's adjusted gross income. As you see from the chart, if you're an unmarried taxpayer, the 3.8% net investment income surcharge applies once adjusted gross income exceeds $200,000. And in the case of a married couple filing a joint return, that threshold is $250,000. As always, we should note that those thresholds for the application of the 3.8% surcharge do not adjust for inflation. So while every other number in those columns adjusts annually for inflation, the threshold for the application of the 3.8% net investment income surcharge stays the same. Before we leave and take a look at the brackets that are in play for estates and trusts, though, I can't help but point out what I think the chart this year does a nice job of giving us a nice simple example that we can use to illustrate what I see as a growing problem in tax legislation. Let's assume, hypothetically, that we are working with a married couple filing a joint return, and that for this year, 2021, that couple has a taxable income of $81,000. Now start to eyeball on the chart where that puts them. You notice that with respect to their adjusted net capital gain and dividend income, it just barely takes them into the 15% bracket, but on their ordinary income, they never get above 12%. You see that there? All right. Let's suppose that for that married couple, their last $1,000 of that $81,000 of taxable income is a qualified dividend or an item of adjusted net capital gain, sale of stock held for more than a year, for example. Well, as the chart indicates there, the first $800 of that capital gain would be taxed at 0%, because it isn't until taxable income exceeds $80,800 that they leave the 0% bracket on the dividend and the capital gain. But notice the last $200 of that dividend or capital gain will be taxed at 15%. Now that's weird, because if that married couple had $81,000 of taxable income, but no portion of it was a dividend or capital gain, that last $1,000 of taxable income would all be taxed at 12%. But instead, we're saying that $200 of the capital gain is going to be taxed at 15%. That's not how the system is supposed to work. When you and I were learning about preferential rates under Section 1H, when we were knee-high to a grasshopper, we were taught that Section 1H contained a trip switch inside of it that provided that, hey, if you're doing the computations here for the tax that you pay on adjusted net capital gain, if the amount of tax that you're going to pay under this section is higher than the tax that you would pay if that item was treated as ordinary income, well, then treat it as ordinary income. In other words, that last $200 should be taxed at 12%. It should not be taxed at 15%. And yet, in the haste to pass the measure that implemented this regime, the Tax Cuts and Jobs Act in December of 2017, Congress just kind of quickly threw the statute together, passed it without very many members of Congress actually reading it, and new Section 1H doesn't contain that trip switch anymore. Now, look, I'll concede this is not a big deal. We're talking about what, an extra 3% of tax on an extra $200 of income. That's what, a $6 increase in tax. Nobody really much cares about that, and I'll grant that. But I think this is a sign. This is the canary in the coal mine. This is showing you, I think, how the seams are starting to fall apart in the Internal Revenue Code. When we were kids, tax legislation was a bipartisan process that took more than a year to implement. Those of us that are old enough to remember the Tax Reform Act of 1986 that gave us the Internal Revenue Code of 1986, remember that that was a product of 2 years of bipartisan negotiation that led to a package that could easily then sail through the House and Senate. But in this century, our template has been rather whichever party is in control is just going to spring tax legislation on the other party, and it's just going to be ramrodded through on a simple majority vote using a reconciliation bill that will expire at the end of 10 years because that's the best that we can do anymore. And as a result, nobody's paying much attention to the details in our statutes anymore. And so little things like this start to evidence the fact that we're starting to lose that internal structure that made the Internal Revenue Code so beautiful. We used to hold up the Internal Revenue Code as an exemplar of well-crafted legislation that, while granted has never been easy to read, has at least been elegant in its word economy and in effectively implementing congressional intent. And that's being just kind of shoved over to the wayside. It's really kind of sad. Well, let's pick things up and have a laugh at our good friends, trusts and estates. Because if I take a look at the tax brackets that are applicable for trusts and estates, they continue to have these anemically thin tax brackets where a trust that is treated as a separate taxable entity finds itself in the 37% bracket once ordinary income pushes them above $13,050. And then once we're above $13,250 of taxable income, dividends and capital gains are going to be taxed for federal purposes at 23.8%. Yeesh. It's bad to be a trust. It's bad to be an estate. I always show these first two slides on the first day when I teach basic federal tax here at Georgia State. And invariably, there'll be some student in the class who will say, well, why is it that trusts and estates are treated so poorly? Individuals have these corpulent tax brackets, whereas trusts and estates seem to be rather starved in the size of theirs because they're so anemically thin. What gives with that? And it's a great opportunity to be able to talk about basic civics with your students as you remind them that unless we're in Chicago, dead people don't vote. And so the lobbyists that are looking at, who are the lobbyists that are looking out for dead people? Zombies? Zombies feed on brains. They're not going to Washington, D.C. to lobby. They'll starve. But Congress isn't really looking out for the dead people. So if we want to implement a tax cut, let's make it a tax cut for C corporations. Let's make it a tax cut for people, because C corporations control the elections and the people are the tools of that. And so it's better to give the tax breaks to the voters as opposed to the dead people. And so, this slide is a reminder that while lately it has become cool to create non-grantor trust for purposes. Remember last year we talked about the use of incomplete gift non-grantor trusts, or INGs as they're called. And we talked about how the Supreme Court approved the use of INGs in the Kastner case and that it was a really smart and wonderful thing to do. That's right. And in that case, you want a trust that's treated as a separate taxable entity. But unless you're trying to achieve a very particular objective for which having a trust as a separate taxpayer makes sense, in the lion's share of situations, we're still far better off to have the trust treated as a so-called grantor trust for income tax purposes, where the income is taxed directly to the grantor, or as a so-called beneficiary-owned trust under Section 678, where the income can be taxed directly to the beneficiary, even if they don't receive it. All right, the last of our little adjustments or inflation adjustments that we have to take a look at for the year relates to the federal wealth transfer tax basic exclusion amount, which for this year, as you already know, is a nice, more even $11.7 million per person, or $23.4 million per married couple. That's a much easier number to talk about with your clients as opposed to last year's 11.58, or in the case of married couples, 23.16 million. 11.7, 23.4, it's much easier to say. Of course, these are astronomically high figures. As we've already talked about, few of your clients really have a taxable estate anymore, for which traditional valuation planning and discounting strategies are really all that relevant or helpful. thanks to the Tax Cuts and Jobs Act increasing the basic exclusion amount to $10 million per person as adjusted for post-2011 inflation, most of your clients are statutory PO folk and don't really have to worry about being considered rich and having assets subject to estate tax at death. Semicolon, however, comma, we all remember that the Tax Cuts and Jobs Act, at least when it comes to individuals, is largely only a temporary tax measure. If Congress does nothing between now and the end of 2025, which I think plays quite well into Congress's wheelhouse, right? When we all wake up in 2026, that means that the 10 million adjusted for inflation exclusion will expire. And we will wake up to a world which the exclusion goes back to being 5 million adjusted for inflation. And if you remember too, we also caused the so-called chained consumer price index inflation model to expire, and we revert back to the traditional consumer price index inflation model. So it's not quite accurate to say that the exemption will cut in half in 2026 if Congress does nothing, because the inflation method from year to year is different. But just so that you have a number, just so you have something with which to wrap your head around, if we assume that inflation rates stay more or less where they have been for the last several years between now and the end of 2025, we could be looking in 2026 at an applicable exclusion amount of about $6.5 million per person or $13 million per married couple. If that's the case, then some more of your clients are suddenly going to find themselves statutorily rich again, and the transfer tax could once again become something about which they have to plan. Of course, what your clients are worried about now is Congress doesn't have to wait until 2026 for that to happen. And with the Democrats in control of the House and barely in control of the Senate and having a Democratic president, what's to stop Congress from accelerating 2026 and causing the exclusion amount to drop sooner? And what's to stop Congress from implementing that retroactive to the first of this year? If a client dies today, we think the basic exclusion amount for federal wealth transfer tax purposes is 11.7, but that's not guaranteed. Congress could later reduce that exclusion and make it retroactive to the start of the year. That's some of the things that have your clients anxious and kind of wondering what sort of strategies can they pursue, which we'll talk about. But before we get there, let's again talk about some of the provisions out of this Consolidated Appropriations Act, the big bill that was passed in December. As you see here from this slide, at being almost 5,600 pages in length, it is the longest bill that has ever been passed by Congress in our nation's history. And it comes with a price tag to match at an estimated revenue loss of $2.3 trillion, almost $1 trillion of which is devoted exclusively to COVID relief. Now, of course, as you know, the Biden administration is trying to negotiate the votes together to be able to get some degree of bipartisan support for another COVID relief bill that itself might cost an additional $1.9 trillion on top of all of this. Where that stands, how that will happen, well, stay tuned for further developments. But at least for now, we can talk about two parts of the Appropriations Act. Buried within Division N of the Act is the COVID-related Tax Relief Act of 2020. This was largely the provision about giving more stimulus payments out. The bigger tax provision found itself in Division EE, to give you an idea of the size of this legislation, with the enactment of the Taxpayer Certainty and Disaster Relief Act of 2020. If you're like me, the first time you read that title, you don't see the word relief there, and you just call it the Taxpayer Certainty and Disaster Act. But based upon some of the provisions that's in there, it really is much more about disaster relief than it is a disaster itself. Let's talk about some of the key provisions from that legislation. Of course, first and foremost, what's dominating the headlines, the fact that there's going to be an additional round of stimulus checks going out to taxpayers that qualify. Remember that these stimulus checks are not money for nothing. They do come in the form of an advance rebate against your 2020 tax liability. So instead of having to wait until you file your return and get the rebate in the mail, you're getting a portion of that rebate up front. It might well be that you then have to recapture it, but based upon the income thresholds at which a phase out for the application of this rebate comes into play, it's not an incredibly likely situation. You may remember that Democrats originally wanted this second round of stimulus to be $2,000 per taxpayer and $2,000 per qualifying child. Republicans dug in their heels, and as a result, the final legislation came in at $600 per taxpayer, $600 per qualifying child. The new round of COVID relief being talked about in the Biden administration, go figure, would add an additional $1,400 to that so we could get back to the original $2,000 that Democrats were originally hoping for. Just like the first round of recovery rebates that were provided under the CARES Act from last March, here too, the rebates phase out if your adjusted gross income exceeds the thresholds that are there. The precise range of the phase outs is not just a function of your filing status, but also how many qualifying children you have. So it's impossible to sort of state succinctly for all taxpayers, look, here's the dollar amount at which you lose out, because the bigger the family, the more the qualifying children, the higher the income you can have before your rebate is fully phased out. But to give you some flavor at where they begin, I provide you with some of the thresholds that apply for married filing jointly, heads of household, and for unmarried or married filing separately taxpayers, so that you could kind of see how it would work and why it is very likely you may not be getting one, or you and your spouse may not be getting one if you're filing jointly. All right, another provision in the Appropriations Act that we should talk about relates to that little $250 above the line deduction that we give to elementary and secondary school teachers. You may remember that several years ago in the Bush tax cuts back in the administration of Bush II, we were all about, hey, we love teachers. Teachers are fantastic. How can we show our love to teachers? Well, we could pay them more. No, really, what can we do? And so Congress thought, well, how about this? A lot of teachers end up paying out of pocket for supplies that they use in their classroom, and their school districts are simply not in a position to be able to reimburse them for those expenses. Well, normally the unreimbursed expenses of an employee in connection with a business are deductible by the employee, but there's a problem because those are miscellaneous itemized deductions. And even before the Tax Cuts and Jobs Act, miscellaneous itemized deductions weren't great because there was that 2% haircut. But of course, thanks to the Tax Cuts and Jobs Act, there's not a 2% haircut, there's a 100% decapitation. You don't get to deduct your miscellaneous itemized deductions. But fear not, said the Bush tax cuts. If you're an elementary or secondary school teacher, we will allow you to deduct up to $250 of unreimbursed out-of-pocket expenses for supplies used in your classroom. And we'll get it as an above-the-line deduction. You can use it in computing adjusted gross income, which means even if you take the standard deduction, you're also entitled to this $250 above-the-line deduction. Well, for many years, teachers have been saying $250 just really isn't enough to be able to fully offset the amount that we're paying out of pocket. But hey, I suppose at least it beats a kick in the eye. What does the Appropriations Act do? Does it increase that threshold from $250 to $500? Does it provide... It just says, well, now supplies used in the classroom includes personal protective equipment, disinfectant, or other supplies that you're using to prevent the spread of COVID. So to the extent teachers are paying out of pocket for their face shields or for sanitizer or for masks for their kids and not getting reimbursed, that can count toward the $250. Well, if they're already paying that amount anyway out of pocket, this particular provision isn't really doing anything more for them. But at least it recognizes that personal protective equipment can count as a supply. A provision from the CARES Act last March allowed college students to be able to receive what the statute referred to as a qualified emergency financial aid grant. It took the Appropriations Act, though, to explain the tax consequences of receiving one of those grants and making clear now that if a college student received a qualified emergency financial aid grant, that grant is excluded from gross income. And moreover, it is not considered income for purposes of computing one of the education credits, the American Opportunity Tax Credit, which remember phases out once your adjusted gross income hits a certain level. Congress makes clear, well, these grants don't count as income in the first place, and they particularly don't count as income for purposes of computing whether you've been phased out of your eligibility to receive the American Opportunity Tax Credit. Although the legislation does make clear that if you received one of these emergency grants as a substitute for a research assistant stipend or for a teaching assistant stipend, Well, to the extent those stipends were gross income as compensation for services, if this grant is a substitute for compensation, then the grant should be taxable and is taxable as compensation for services. But otherwise, good news to students or to family members who had received a qualified emergency financial aid grant. All right, one big provision out of the Appropriations Act relates to a brand new round of so-called Paycheck Protection Program loans. You will remember that the Paycheck Protection Program had its genesis in the CARES Act back last March. And remember, when the CARES Act was passed, everybody was thinking that the pandemic was only going to last for a couple of months, maybe 3 months at most, and then everything would go back to normal. Why we believed that in retrospect, I suppose, kind of stumps us all, but we were convinced, just stay in your house for 14 days, this whole thing goes away and we can get back to normal. But we understand that many small businesses are in a position where if they just close their doors, then they're starving out their staff. And when they try to reopen, the staff may have relocated elsewhere. So remember, the whole idea behind a Paycheck Protection Program loan was for you to get a loan from the Small Business Administration if you qualified. And as long as you used at least 75% of the loan proceeds to cover your payroll, to cover interest payments on pre-existing mortgages, to cover rent under pre-existing leases, or to cover utility expenses under pre-existing utility service contracts, then the Small Business Administration will forgive that loan. And then, under the heading of this has got to be too good to be true, the CARES Act even provides that when the Small Business Administration forgives the loan, that forgiven debt is not included in gross income. Well, holy cow, right? If I went across the street over here to my bank, which my bank really is across the street from here, and I'm kind of wondering why these guys who have ski masks on are currently loitering around outside of it, but what could possibly go wrong? Anyway, if I were to borrow $100,000 while it's still there from my bank and use it to pay payroll to my employees in my meth operation or what have you, well, don't use that. I can't deduct expenses there anyway. In my sweater vest manufacturer operation, it's my side hustle. If I pay those wages out there, if my bank forgives the loan, that forgiveness of debt under 61A12 is included in gross income. And unless under Section 108 of the code, I am insolvent, or the debt is discharged in bankruptcy, or I incur the debt in connection with certain real property or farming businesses, that cancellation of debt is included in gross income and I have to pay tax on it. And that makes sense, because if I borrow money, I don't have gross income because of the offsetting obligation to repay. But if that offsetting obligation to repay is taken away, why isn't that money for nothing part of gross income? It should be. It is. But under the Paycheck Protection Program, as long as you're using it for an okay cost, it's not. Wow, these were fantastic. No wonder people were trying to clamor onto these as quickly as they could. Second round of funding was authorized over the summer when the initial funding wasn't enough and when the pandemic was unfortunately lasting longer than we expected. The appropriations bill allows for yet another round of Paycheck Protection Program loans, including providing that people who've already taken out one loan can ask for a second loan now. Now, you may remember that last summer, employers were starting to balk at this requirement to use 75% of the loan proceeds toward payroll because they thought, well, but my problem is my business has been shut down for so long, or I've had to contract the size of my business in reaction to the pandemic, that I don't have those employees anymore. And it's impossible for me to spend up to 75% of the loan proceeds within the 8 or 24 week period that applied to my loan, that I had to be able to hurry up and use it. So you might remember that last summer, Congress passed the Paycheck Protection Program Flexibility Act. And under that Flexibility Act, Congress said, well, hey, instead of giving you 8 weeks to use the proceeds for that purpose, we'll give you 6 months to use the loan proceeds for that purpose. And instead of making it so that you have to spend 75% of the loan proceeds on these permissible purposes, we'll now, as the slide shows you, only require that 60% of the loan proceeds be used for those purposes. Well, the Appropriations Act steps up and makes it even more likely to qualify for forgiveness, because under the Appropriations Act, there's 4 more ways in which a taxpayer may use Paycheck Protection Program loan proceeds to meet the 60% threshold required for forgiveness. The taxpayer can use the loan proceeds to cover what the statute calls covered operations expenditures. This goes for things like software or for cloud storage or for HR or for payroll or accounting. All of those costs of the business are now an eligible use of loan proceeds. The statute specifically includes covered property damage costs, which specifically targets costs that a business had to pay for to make repairs after vandalism and looting from civil unrest activities in calendar 2020. If any of your clients had businesses in downtown Portland where those types of events did take place, to the extent that they use Paycheck Protection Program loan proceeds to put windows back into play or to make repairs to their business premises damaged in civil unrest, riots, or protests, then they can qualify, again, help qualify for forgiveness from the loan. We also include so-called covered supplier costs, which relates to if I had a pre-existing contract from a vendor to supply me with goods in my business, then to the extent I'm making payments under that pre-existing supply arrangement, those payments can count toward meeting the 60% threshold. And similarly, to the extent that I incur costs in sanitizing or implementing social distancing guidelines in my trade or business, whether that's through plexiglass shields or increased costs of disinfectants, face shields, masks, and the like, those are called covered worker protection expenditures, and expenses that way can also count toward meeting the 60% threshold. So the Appropriations Act not only authorizes another round of loans, it makes it easier to qualify for forgiveness from those loans. But now let's go back to one of the first queries that we were all debating as a profession when the CARES Act first came out. Suppose instead of borrowing from my bank next door that might be a few $1,000s lighter than it was just a few moments ago, what if I borrowed instead from the Small Business Administration via Paycheck Protection Program, and I used let's say I borrow $100,000 from them, and I use all $100,000 to pay off my employees on their payroll. Can I deduct the $100,000 that I pay to my employees? Prior to the Paycheck Protection Program, nobody would blink an eye and say, well, of course you can. Go back to my example where I borrow from my bank across the street. If I borrow $100,000 from them and use it to pay my employees, of course I get to deduct the compensation paid to my employees, because the deductibility of compensation that I pay to an employee does not depend upon the source from which I gathered the money to pay that compensation. Again, as long as I'm legally on the hook to be able to repay the loan, ultimately that cost is being borne by me. Even if not up front, I get the deduction. But if instead I'm funding that payroll through a loan that I expect to be discharged and not included from gross income, then I'm not really paying that cost out of pocket, am I? It's the Small Business Administration ultimately that is paying that compensation to my employees. So maybe I shouldn't get a deduction. And you may remember that Treasury had issued guidance first in the form of Notice 2020-32, and then subsequently in Revenue Ruling 2020-27, in which it said, no, you don't get to deduct any compensation that is paid using proceeds that are likely to be excluded from gross income. Well, the Appropriations Act says, excuse me, that's not going to be the rule. Quoting directly from the statute, no deduction shall be denied. No tax attribute shall be reduced, and no basis increase shall be denied by reason of excluding a forgiven Paycheck Protection Program loan from gross income. Effectively overruling that prior guidance and saying, yes, you can still deduct the $100,000 that you're paying, Sam, to your employees, even if your loan from the Small Business Administration is subsequently forgiven and excluded from gross income. I'm getting a double benefit. I'm getting tax-free dollars, and I'm getting to deduct compensation that ultimately I'm not really paying. And moreover, to make it clear, the statute provides that if I'm an S corporation shareholder or a partner in a partnership, the pass-through entity is supposed to treat any excluded Paycheck Protection Program loan proceeds as tax-exempt income. So if my S corporation borrows $100,000 from the Small Business Administration and qualifies for forgiveness, that $100,000 is to be treated as tax-exempt income, which is important because remember, an S corporation shareholder is increased by the shareholder's share of tax-exempt income. And so by giving that basis increase, we effectively ensure that if there's a subsequent distribution of those dollars to the shareholders, that we're not ultimately taxing what is supposed to be tax-exempt money across the board. So the Appropriations Act confirms, yes, you can deduct the payments. We'll give you basis increase if you are a shareholder in an S corporation or a partner in a partnership or in any entity that is treated as a partnership for tax purposes. Paycheck Protection Program loans were already great. They're that much sweeter as a result of the Appropriations Act. Okay, another provision inside the Appropriations Act was to kind of sort of recycle a rule that came from the CARES Act. Let's cite the Appropriations Act rule here first. That's the one that's on the slide. For this calendar year only, if you do not itemize your deductions, in other words, if you are a standard deduction taxpayer, just like last year, you are allowed to deduct up to $300 in cash contributions made this year to a public charity. You don't get this $300 above the line deduction if you make the contribution to a private foundation or to a supporting organization or even to a donor advised fund. If I have my favorite charity out there, Lawyers Without Yachts, I have to cut a check directly to Lawyers Without Yachts. And the first $300 of it can be above the line. And unlike last year's legislation, this year it's clear in the case of a married couple filing a joint return, that $300 limit instead becomes a $600 limit. Now, this rule sounds very much like the rule that was in play last year under the CARES Act, but there's a couple of key differences, right? For one thing, we know that last year's amount was $300, and the Joint Committee on Taxation made clear that is $300 per filing unit. So even a married couple filing a joint return combined get $300 as their maximum above the line deduction. This time around, though, again, married filing jointly gets up to $600 of above the line deduction. Last year's CARES Act was clear that this deduction was taken out above the line, that is, in computing your adjusted gross income. This year's statute provides that you get to claim this $300 in addition to the standard deduction, but it does not say that you get to take that deduction in the computation of adjusted gross income. Well, that tells me then that this extra $300 or $600 for a married couple to non-itemizing taxpayers is not an above the line deduction, but instead is taken in addition to the standard deduction below the line. So a taxpayer who's taking advantage of this would have gross income minus above the line deductions to get adjusted gross income. Then that taxpayer would subtract the standard deduction. Then that taxpayer would subtract up to $300 of these cash donations, plus, if applicable, the deduction for qualified business income under Section 199 Cap A, because that too comes out below the line, but in addition to the standard deduction. In both cases, both last year and this year, though, it applies only to actual cash contributions made during the calendar year. If I made a big old honkin' charitable donation last year, and because my AGI was so low, I had to carry over a portion of that deduction to this year, I can't use that carryover to help fund this $300 or $600 in addition to the standard deduction charitable contribution deduction. It has to be an actual out-of-pocket cash contribution made this year. Donation of marketable securities, no good. A donation of valuable sweater vests, no good. It has to be a cash contribution, or by check or by credit card. You kind of get the idea. Okay? All right. Next up, just to summarize a few other key provisions before we start talking about some other developments that deserve some attention in our update presentation. The Appropriations Act makes clear that for all taxpayers forever forward, everybody gets to use the 7.5% of adjusted gross income threshold for the deduction under Section 213. You'll remember that for many decades, the code provided pretty consistently that a taxpayer could only deduct medical expenses to the extent that in the aggregate, they exceed 7.5% of adjusted gross income. But for 2013 through 2017, the code provided that, well, that 7.5% only applies if you're age 65 or older. If you're not yet age 65, you have to use 10% of AGI, which makes it, of course, harder to be able to deduct your medical expenses. And to the extent you can, obviously, you can only deduct a smaller amount if you only get to deduct that which is in excess of 10% of AGI. Well, we'd always had this thing where a little piecemeal, we'd say, no, we'll let everybody use 7.5%, but just for a limited time. Now the Appropriations Act makes clear this is not for a limited time only. This isn't like the McRib where you got to hurry up and take advantage of it. Now, until Congress just decides to change its mind, everybody, no matter the age, gets 7.5% greater chance that you'll be able to deduct a portion of your medical expenses. Interestingly, and seemingly from nowhere, Congress just plain got rid of the deduction for qualified tuition and related expenses. There used to be that education expense for college education deduction that was available. We're not talking about the deduction for student loan interest. That still exists. We're talking about the deduction for paying for tuition and books and supplies and other stuff used in the classroom. But to offset this deduction, Congress at the same time increases the thresholds before there is a phase out of the lifetime learning credit, the other major education tax credit that's available. Congress's intent here is to be friendly. The intent is to say, well, instead of giving you a deduction which only saves you tax at your marginal rate, let's instead give you a bigger credit by saying that the credit doesn't phase out until your adjusted gross income reaches a higher threshold. So if you qualify for the credit, you're going to get a bigger credit instead of getting a deduction. And of course, you always prefer a credit to a deduction because $1 of credit saves you $1 in tax. $1 of deduction saves you anywhere from 10 cents to 37 cents, depending upon what your marginal tax bracket is. So the thinking here is that this is supposed to be more or less revenue neutral and designed to be more or less a push on the revenue constraints, but we'll see. I guess it's maybe towards simplification. Who knows? We are yet again excluding the exclusion from gross income if your bank discharges your home mortgage. That cancellation, ever since 2009 in the housing crisis, we've had temporary provisions that have said, well, for now, if your bank forgives your home mortgage, you don't have gross income. That's always been consistently resuscitated, usually for just a year at a time. The appropriations bill now makes it last all the way through 2025 so that we don't have to keep renewing it every year. But notice there is a cap. The maximum amount of a home mortgage discharge that you can exclude from gross income is $375,000 unless you're married filing jointly, and it's double that at $750,000. If you have to pay mortgage insurance, you may remember that there have always been this, since the housing crisis, there's been this little temporary rule of where we will treat your mortgage insurance as additional mortgage interest, which if you're already itemizing and deducting your qualified residence interest, you could just add this on top of that for the deductible cost. This too has been extended, though for whatever reason, this one's only been extended through this year as opposed through 2025, like the exclusion provision on the cancellation of home mortgage loans. And then, again, just out of nowhere, Congress provides that for this year and next year only, instead of deducting 50% of the cost of a deductible business meal, you can deduct 100% of the cost of a deductible business meal if that meal is furnished by a restaurant. Obviously, here we're trying to help save restaurants and to stimulate investment in restaurants by making the deduction 100% effective or 100% deductible as opposed to just 50% deductible. Well, how does that mesh with the fact that the 2017 Tax Cuts and Jobs Act completely repealed the deduction for entertainment expenses? Because after all, if you take a client to a Blazer game, well, in addition to the Blazers, watching the Blazers from whatever seat you're watching, you got to pay what? An additional $20 for a beer and $10 for some stale popcorn. Do you get to deduct that? Or do you deduct the $20 cost of the hot dog and then the $200 trip to the emergency room after having had that hot dog? What's all involved in that? Well, on this slide here, I try to sort of give you a crib sheet to the guidance of to what extent are these expenses deductible and not deductible. It is still the case, even after the Appropriations Act, that the cost of the ticket to the Blazer game itself is not deductible, nor can you deduct the cost of transportation to or from a business meal. You still can't deduct any of your club membership. Furthermore, if your Blazer ticket entitles you to a free hot dog or to a free popcorn, you cannot deduct that portion of the ticket price that you think is realistically related to the hot dog or to the popcorn. Unless that charge is separately stated, it is part of the non-deductible entertainment expense. Now, you can still deduct just 50% of the cost of meals that you furnish to employees on your business premises, but if it's provided by a restaurant, it goes up to 100%. If you're just paying for Doritos and Cokes at the office, though, that's still only 50% deductible because that's not coming from a restaurant. On the other hand, if you're out having a meal during business travel, well, since that meal is being provided by a restaurant, it's now 100% deductible. Similarly, meals at a conference. Oh, that will be so nice, won't it? To the extent it is provided by a restaurant or by a hotel that's operating a restaurant within its hotel facility, that's going to be 100% deductible, as is the cost of a client business meal, as long as it meets the normal business meal tests. That is, that you, the taxpayer, are present and that the overall cost is not lavish or extravagant under the circumstances. If the meal's provided by a restaurant, well, yay, it gets to be 100% deductible instead of just 50%. All right, that's enough. And besides, I'm getting hungry here talking about meals. Let's move along and talk not about what legislation has recently been passed, but what legislation we might expect to come into play under a so-called Biden tax plan. And I want to talk about some provisions that we might expect under a Biden tax plan that impact corporate tax, individual tax, and estate and gift tax. To research this, rather than just sort of relying on what the Wall Street Journal speculates, I decided, why don't I just actually go dig into the Biden campaign website to see what actually the Biden campaign says it wants to do? Why not read through the Democratic Party platform to see what the Democratic Party says it wants to do? And there are some tax provisions in not only the Biden campaign website, but in the Democratic Party platform. It ain't easy reading, because if you're looking for something that's balanced and neutral in its perspective, party platforms aren't going to do that for you. But it was kind of interesting. There were some interesting ideas that was there. On the Biden campaign website, there was this, hey, we just got done implementing a 21% rate on C corporation taxable income. What if we increase that rate to 28%? Now, the nice thing about a campaign website, you don't have to go into detail here. Are you talking about replacing 21 with 28? Are you talking about adding a 28% rate so that there would be some degree of progressivity? Are you talking about going back to progressive rates that cap out at 28% instead of 35%, where the rates had left off before the 2017 Tax Cuts and Jobs Act implemented a flat rate? Nobody knows. And there's Satan lurking in the weeds. The devil's in the details. We'll only really be able to pass judgment once we actually see some real legislation. But one interesting proposal that's out there is this idea for C corporations that are publicly traded. If they are in their public disclosure documents on their income statements, if they're showing to their shareholders that they're making $100 million or more of book income, then Biden says, then we think that at a minimum, you ought to be paying 15% tax on that amount that you're showing to your shareholders. Because we all know the situations, right, where the C corporations are claiming hundreds of millions of dollars in net income on their required to be disclosed financials. But then when they file their Form 1120, their C corporation tax return, magically they're showing zero taxable income or negative taxable income. Not because they're cheating, not because they're doing anything wrong. They're just taking advantage of tax incentive provisions that are in the code. But still, it doesn't look good that you and I, who are not making 9-figure taxable income figures, are paying tax when those C corporations are not. So this idea of some kind of minimum tax on book income is intriguing. Doubt it's going to go anywhere, but it's certainly intriguing to talk about. Some of the things that you have been hearing and which Biden administration officials have been openly trumpeting to this point, things like getting us back to a 39.6 maximum marginal tax rate, getting rid of the preferential rate on capital gains, but then they again just kind of speak in generality because they say for those making more than $1 million. Well, what do you mean by that? Do you mean taxable income? Do you mean adjusted gross income? Do you mean gross income? Do you mean book income? Those are all four very different figures. And which one of those you choose to use as your baseline for this $1 million threshold will kind of matter for how many of our clients would be impacted by that kind of rule. Certainly something that's been getting a lot of attention is increasing the size of the child tax credit, currently at $2,000 per child, a non-refundable credit. But remember, you have to have a certain amount of earned income just to qualify for this child credit. Well, the Biden plan talks about not only increasing the credit to the sizes that you see there, but also getting rid of the requirement that you have earned income to be eligible for it. Just having the kid will be enough. And then furthermore, the Biden plan also calls for making the child tax credit a fully refundable credit as well. Many Republicans have been balking at some of those latter details, although the general idea of increasing the size of the child tax credit is something that seems to enjoy bipartisan support. The Biden plan also talks about bringing back that first-time homebuyer credit that we had back during the housing crisis. Remember, we used to say that to the extent you were buying your first ever home, we would give you this $15,000 credit against your taxes. It originally came out in the form of a loan that you would have to repay over the next 15 years, but that wasn't popular. So we just said, you don't have to repay it at all. Then it became unpopular because it only applied to first-time home buyers and it didn't apply to empty nesters who, now that they got rid of the kids and no longer had, $600 grocery bills every other day that they were incurring, that wanted to move into smaller places but felt inhibited because of the costs that were involved, we made it available to empty nesters too. If this comes back, does it come back at where it left off? Does it come back in its original form? We'll just have to kind of see how it plays out, I suppose. But importantly, on the estate and gift tax front, for whatever reason, the Wall Street Journal has been consistently saying Biden wants to take us back to 2009 when the exemption amount was $3.5 million per person, $7 million per married couple. Well, that ain't coming from the campaign website. That's not coming from the party platform. Best as I can tell, the Wall Street Journal is just figuring that, well, because Vice President Biden supported Obama-era budget proposals that said, let's go back to 2009, they seem to suggest then that President Biden must, therefore, being the loyal guy that he is, also agree to that $3.5 million. But we don't know that for sure. But could we see a quicker reduction in the size of the exclusion? That's very possible. Some have speculated, are we going to see the repeal of the step-up in basis and go to a carryover basis regime? On that one, I almost kind of have to giggle, right? Because we've talked about this at other update presentations at this seminar in the first 50 years of this seminar. We don't have a step-up in basis because of some grand policy pronouncement about fairness or equity or anything else along that line. We have a step-up in basis because of administrative convenience. Because once grandma's died, figuring out what she paid for Blackacre back in the 1850s when she acquired it as land grant from the federal government in the Oregon Territory was near impossible to know. But fair market value at date of death, that we can determine. So let's just give, and to the extent we all agree that few of our clients are dying as an income tax dodge, we're kind of fine with just saying if we never managed to tax the taxpayer while they were alive, well, what's the compelling reason to tax them at death? It's not like they died on purpose to not pay any tax. Well, George Steinbrenner may have, but I'm not so sure that many other folks would have. So I'm much more skeptical about any changes to the step up in basis because that's a rule of such administrative convenience and would seem to meet with so much resistance. It's almost a political sacred cow. It'd almost be like getting rid of the home mortgage interest deduction. I just don't see it happening. But a reduction in the exclusion amount? Yeah, that could happen. So let's kind of put this all together based upon very low interest rates, low asset values, a potential change to the basic exclusion amount, a potential increase in income tax rates. As a result of this unique environment in which we are, what are the cool kids doing these days? Well, I think a lot of folks are saying, hey, this still might be another good year in which to harvest capital gains in my portfolio because I might be in a tax bracket that's less than what I've been in the past. And so maybe now is the right time, especially if I think tax rates are going to go up under a Democratic Congress and a Democratic president. This might be the time. So far, Treasury Secretary Yellen has indicated that any tax reform would be prospective in nature. So if I can hurry up and harvest a capital gain before any tax legislation gets passed, I've been told that it would be prospective only. I can't detrimentally rely on that and then say, well, therefore it would be unconstitutional if they made it retroactive just because the Treasury Secretary said we would like it to be prospective only. But that is at least a pretty good signal that we'd be looking only at prospective increases in brackets. So this could be a good time to harvest capital gains. This could be a good time to do a Roth conversion if I have a traditional IRA, because if I expect that I will be in a higher tax bracket in retirement than I am currently, even though the conversion is taxable, if I'm paying the tax now at a smaller rate, depending upon how far it is away from when I retire, well, then maybe I want to go ahead and do the conversion now because I actually come out ahead. And then likewise, when interest rates are so low, doing leveraged wealth transfers, doing large gifts, particularly if we think the exclusion amount is going to go down, I want to hurry up and take advantage of that now. So if you have clients that are going to make gifts in anticipation of the exclusion amount going down, a couple of techniques that I think deserve a lot of attention is the traditional installment sale to a defective grantor trust. Since the Section 7520 rate, or actually since the applicable federal rate of interest is so redonkulously low right now, installment sales become, I think, a very tax efficient way to be able to shift assets outside of an estate if you think the client is going to be facing estate tax exposure between now and the date of death. Likewise, I think charitable lead trusts right now look really good, because remember, when you form a charitable lead trust, you are today making a gift of the present value of the remainder interest that's going to go to the non-charitable beneficiaries. If the 7520 rate in effect at the time you create the trust is very low, however, Treasury's own 7520 annuity tables assume that there will be very little, perhaps nothing, left in the remainder, the present value of which is ridiculously low. And as long as the trustee of your charitable lead trust can invest the assets at a rate that beats the 7520 rate, which is currently 0.6%, then there's a very good chance that, in fact, you'll come out far, far ahead. So the lead trust strategy looks really impressive at this point. Some things to consider, though, if you're going to have a client make a gift. Your clients might want to make a gift now, but then regret it if it turns out that the exclusion amount doesn't go down. They're going to say, I want that gift back. I thought the exclusion was going to go down. It didn't go down. Give me back. Some will say, well, one thing that you could do is insert a disclaimer so that if you have a friendly recipient, like the trustee of a trust, for example, the trustee could not accept the benefit of the gift and we can wait 9 months. And if the exclusion doesn't go down, maybe the cooperative trustee disclaims the gift and the property can revert back over to the grantor. You take a lot of risks with that. And plus, you kind of put the trustee in a bit of a fiduciary pickle, because I believe their duty is to the beneficiary as opposed to the grantor. And while there's an argument to say it's in the best interest of the beneficiaries to disclaim this gift, all you need is one squawker beneficiary to kind of be the fly in the ointment, or the the fly in the cogwheel, and we could end up having some things that become very difficult for trustees going forward. So a lot of people shy away from the disclaimer approach. One technique that I've seen a lot of planners do, though, is they take advantage of those trust protectors, right? These people who aren't trustees, they're not fiduciaries, but if we reach a point where we say, okay, let's go ahead and make a gift into a trust now, but then it turns out that the exclusion amount never goes down, and the client thinks, if I had a do-over, I wish I hadn't made that transfer, because if I put assets into an irrevocable trust to get them out of my estate, when I die, those assets don't get a step up in basis. Is there a way that I can put the assets into an irrevocable trust, but provide that they do get a step up in basis if it turns out that I don't have to pay any estate tax at all? Well, here's where this third party, this trust protector, comes in and waves some magic wand, Wingardium Leviosa, and voila, we give to the grantor a general power of appointment, power to be able to appoint the remainder by testamentary document, by will, what have you, to the creditors of the grantor's estate. Anything that makes it a general power of appointment causes those assets to be included in the client's gross estate, and thus they get a step up in basis for income tax purposes. So I see some people say, let's make the gift to the irrevocable trust under the assumption that you will be rich again and that we want to get these assets out of your estate. But in case we want to get a last minute step up in basis, we've got a technique that allows us to be able to do that. Lastly, if you're going to have a client who makes a gift of a difficult to value asset, please make sure that they're only giving value as opposed to giving the underlying asset. The written materials that you have talk about last summer's case from the tax court, Nelson versus Commissioner. In that case, you had a client who was making a gift to a trust followed 2 days later by a sale. It was a straight over tackle installment sale to a defective grantor trust that was preceded a couple of days by a seeding gift, right? Well, here was the language by which the donor made that transfer to the trust. I give a limited partner interest having a fair market value of $2,096,000 as of December 31, 2008, as determined by a qualified appraisal within 90 days of this agreement. Followed 2 days later by a sale of $20 million of limited partner interest, again as determined by an appraisal. Well, at first, this looks to be smart. This looks to be consistent with our use of so-called Wandry formula clauses, where we know that you can make a gift of value like this rather than saying I give 10% and I sell 80%. Instead, you can say I'm going to give $2 million worth of limited partner interest, and then I'm going to sell $20 million worth of limited partner interest. But the problem in this case, look at that language again. In both the gift and the sale documents, the documents say that I'm going to give whatever is the interest that the appraisal says is worth $2 million or $20 million, respectively. So if the IRS can come in and show that the appraisal got it wrong, that it was aggressive in the discounts, and that in fact the size of the interest that transferred that the appraisal said was worth $2 million was in fact worth $3 million, well, unlike a formula clause that would then adjust and say, well, then we're going to give a smaller percentage interest, this language says you're stuck with making whatever the appraisal says has a fair market value of $2 million or $20 million. So that would mean that you're making a taxable gift in 2008 and you're making a taxable gift in 2009 under the sale. And the tax court agrees and says, yes, that ends up being the correct result. Whoops. That wasn't supposed to be the case. So what they do in Wandry that worked? Well, in Wandry, the gift was expressed as I give $2 million worth as finally determined for federal gift tax purposes. So as to make it clear that whatever is the ultimately determined value, it's going to be $2 million of that is going to transfer. Thus protecting yourself, because if the IRS comes and challenges the valuation, you now say to the IRS, well, thank you for being on the ball. I thought I needed to transfer a bigger chunk of interest to satisfy this gift, but you're telling me it's a smaller amount and I can keep more. Okay, I'll do that. Thanks very much, but you don't get to collect any additional tax because I said my gift was whatever was finally determined. Well, a lot of practitioners are nervous about using that exact language because even though it worked in Wandry, they say, well, wait a minute, when is the value finally determined for gift tax purposes? I mean, don't you have to have the IRS challenge it? And don't you either have to have a settlement or a decision from the tax court or a federal district court or the expiration of an appeal before you know the finally determined value for gift tax purposes? I think there's an easy way around that. What you do is you say, I'm going to give $2 million worth as determined by this appraisal, or if less, what is left of my remaining basic exclusion amount, so that you can cap the amount of transfers. You can say, well, yeah, I'm going to use this appraisal, but in no event do I want the gift to exceed what is remaining of my exemption amount, or if you want to specify even an exact dollar amount, $2 million, you can do that. That way, again, if there's a challenge by the service to the valuation, you can say, well, then my little savings clause over here that says, but in no event shall the gift exceed this, what remains of my exclusion amount, should serve to protect you. And I think most commentators all sort of agree that that language is sufficient enough to be able to work. If we had a little bit more time together, I'd go into loving detail about the use of the so-called ultra long-term GRAT or the 99-year GRAT. This is the idea that instead of creating a short-term GRAT for just 1 or 2 years, I create a GRAT where I know the client is going to die. Why on earth would I do that? Because normally if a client dies while a GRAT's still in existence, you have to include the assets in the GRAT in the gross estate. Yeah, but regulations say that the amount included in the decedent's gross estate is capped by an amount determined by this fraction. Take the annuity amount and divide it by the 75/20 rate at death. Well, remember the 75/20 rate today is very low. If I think that the 75/20 rate in effect at death is going to be higher than the 75/20 rate now, I actually am going to come out ahead. Here's a simple example to illustrate that. If I have a client create a $10 million GRAT today, February 3rd, 4th, whatever it is, 4th, 2021, when the 75/20 rate is 0.6%, which it is. In order for me to zero out that GRAT, so there's no taxable gift, the amount of the annuity I have to pay to the client, as you see, is just under $200,000 a year. Well, if my client dies 20 years later, and if the 75/20 rate happens to be 4% at that time, then if I take $198,957 and divide it by 4%, that gives me a number that, as you see there, is just under $5 million. But if the assets are growing at a modest 5% a year, even after I pay out $200,000 of annuity to the grantor each year, that trust after 20 years is in fact going to have nearly $20 million inside of it. So while I'm including $5 million in the client's gross estate, there's $20 million inside the trust. $15 million of it is passing completely free of tax. So you don't have to do these short-term GRATs. A long-term GRAT makes a lot of sense if you're betting on the fact that the 75/20 rate at death is going to be significantly higher. And for your healthy clients in their 40s and 50s and 60s, this is a pretty good bet. And a number of practitioners are doing strategies just like it. There's a few other strategies that we could end up talking about too. We could talk about SLATs, and nobody does spousal lifetime unitrust because the acronym there isn't nearly as sexy or as good, right? We could be talking about any of those, but here's all the stuff that we would have talked about if they'd allocated me 4 hours instead of just the 1 hour that's there. But I've been asked to leave at least a couple of minutes available here for some Q&A. So why don't I see what we have here by the way of the Q&A. First part of it here is how many retroactive tax increases have there been in the past? Asks Sean DeBerg. Well, to some extent, the Tax Relief and Unemployment Insurance Reauthorization and Job Creation Act, GRJCA, in 2010 was kind of retroactive. Some parts of it was made prospective only when they said, for example, yes, there is an estate tax and it's retroactive back to the 1st of 2010, but you can elect out of it. And if you elect out of it, you also elect into a modified carryover basis regime. So, there's an argument, and the tax increases that happened in some of the rates were then applicable there for 2010. So there have been some instances in which tax legislation has been retroactive, but clearly the longer you go within the year, the less the chance Congress politically wants to expend the capital to make something retroactive. That's not to say that we're past the deadline by which something would be made retroactive now, but I'd feel a lot better if our first round of tax legislation was in the summer or the fall or the early winter, as opposed to sometime this spring. Another question, any opinion on how the Biden administration is likely to treat captive insurance companies, asks Adam Rose. There's been some speculation that captive insurance companies may not continue to receive favorable treatment, but there haven't been any specifics that I've been able to identify. And given that there was enough specifics to be able to talk about, the fact that there's not anything specific on this suggests it may not be a high priority item. That said, though, I think none of us would be surprised if we saw that rules might become a little bit less favorable, but nothing that makes me currently think that somebody needs to be doing something sooner rather than later, although who knows. Another question is, what year does the permanent 7.5% medical expense begin, asks Tara Siegman. That begins in 2020. I think it was made retroactive for 2020. We had previously seen, it wasn't the CARES Act, it might have been some extender bill before that had made 7.5% available for everybody for 2020. And this just basically kind of continues the ride. Last question that Michelle Wasson asks, do I think the full SALT deduction for state and local tax will come back? In other words, not having that $10,000 cap. Well, if I was a betting man, and my bookie says that I am, I have a hard time seeing it come back, honestly, because remember, that would be a revenue cost provision. And given how expensive the Appropriations Act is and how expensive this new COVID relief bill is going to be, assuming one passes, if we get to a tax bill, there's virtually no way that it can have a deficit. I think Congress is going to be looking for ways to make money rather than lose it. So, I would be hesitant to say that we would be going back to a day of unlimited state and local tax deduction anytime soon. Some folks were squeezing in some last minute questions, but unfortunately, we're not going to have time to be able to answer these here over the webcast. I'm a state employee. I can't work overtime unless I got permission ahead of time, which I didn't do. And besides, it's coming across on lunchtime right now, right? And after that discussion of business meals, we got to go to a restaurant and keep a receipt so we can take advantage of the 100%. Thanks very much for your attention this morning. I hope we have the opportunity to be able to see each other at the downtown Hilton this time next year for the 51st estate planning seminar. See you later.
Thank you everyone for joining today. We now have an hour for networking in the exhibit hall and lounge. Please take this time to get a refreshment, but do come back and visit the sponsor booths, learn of those services to support your practice, and enter to win some great prizes. Thank you.